Please take your seats. The program will begin in 5 minutes. Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. please welcome to the stage Bloomberg's Derek DeCluet and Melissa Shin.
Good morning. Thank you so much for joining us. I'm Melissa Shin. I'm Bloomberg's Toronto Bureau Chief, and welcome to the 12th Annual Canadian Finance Conference.
And I'm Derek DeCluet. I'm the Executive Editor for Bloomberg News in Canada, and we are grateful that you could join us today.
Today, we'll hear from finance, government, and business leaders from across various sectors as they discuss advancements in their fields and how they are sustaining their leadership going forward.
We're continuing in this tradition. As Melissa said, it's the 12th year of providing timely insights and strategies for a global audience of leaders and investors. And before we get started with the program, we have a couple of announcements.
First, we would like to acknowledge our sponsor, National Bank of Canada Capital Markets.
For our virtual attendees, if you experience any issues with the audio or video quality, please try to refresh your browser or use the chat box on the bottom right corner of the screen, and you can ask for support. We've also partnered with a audio to text platform which transcribes the discussion in real time to make this event more accessible. You can access that transcription via the link in the session description.
Also, we would love to hear from you throughout the program. To submit questions virtually, please click open the white tab on the right side of the video window. And for those of you in the room with us, you can submit questions by scanning the QR code on the screen.
And if you're still into social media and you want to post, you can use the hashtag BBG Canadian Finance. That's what we'll use today. Great.
And with that, please welcome Yves Poirier, Consul and Chief Representative of the Department of Finance at the Consulate General of Canada in New York, who will share with us some opening remarks.
All right. Good morning, everyone. Bonjour tout le monde. Thank you, Melissa and Derek, for the introduction. It's a real pleasure to be here this morning. Let me start by thanking Bloomberg and National Bank for organizing again this year an exceptional conference with such an impressive lineup of panelists and speakers. 12 years running, it's quite a success, and your commitment to shining a spotlight on Canada's economy and capital markets are really commendable, so we thank you for that. Canada is on display today here in New York City in the United States because of the importance of the Canada-US partnership, the value of which cannot be overstated. Canada and the US are not just neighbors, we literally are part of each other's lives. About 2/3 of Canadians live within a 60-minute or so drive from the United States. Canadian companies, some of which are represented here today, employ 900,000 workers in the U.S. 8 million jobs, 8 million U.S. jobs are tied to trade with Canada. One last statistics, each and every single day, even this year, $2.5 billion, and that's U.S. dollars, worth of goods and services cross the border up north every day again. And none of this would happen without efficient capital markets. And so that's why I'm pleased to see such a remarkable turnout of issuers, buy-side investors, financial leaders from both sides of the border here this morning. Your presence underscores the essential role you play in facilitating the flow of capitals between our two great nations. So thank you for being here today. On a personal note, this is my second Canadian Finance Conference since moving to New York City just over a year ago. And let me tell you what a year it's been. Think about where things were 12 months ago and how things have changed. Personally, when I arrived in August of last year, one of the difficulties I had in this city was to try to spark a conversation about Canada. I think we were often seen as the trusty, innocuous, reliable neighbor up north, steady, dependable. But to be frank, I think people thought we were a bit boring. because nothing really ever happens in Canada. At least that was the view of some people around here. Well, things have changed indeed. Canada is now very much part of the conversation, and not always in the quiet, understated way we used to be known for. The world has changed, and so has Canada. So this morning, I just want to leave you with just 3 things about Canada. I won't take up too much of your time, I promise. Hear me out. So the first thing is that I want to tell you is that in tomorrow's economy, Canada is what it needs to succeed. We have the talent, one of the most educated and diverse workforces in the world. We have the capital. Our pension funds, some of which are represented here today, are some of the largest and most sophisticated investors in the world. Our banking system is, of course, one of the safest and soundest in the world. We have energy, a lot of energy. We are one of the largest exporter of natural gas in the world. We're ramping up our LNG export capacity, and we have one of the largest reserves of oil and gas in the world. And we produce a lot of electricity. Electricity is in high demand. We produce a lot more than we consume, so we export the rest here, and we have planned to produce even more in the future. Our electricity is cheap and clean. 85% of our grid is non-emitting. Critical minerals, basically, we have all of them almost. I mean, think about one. We probably have it in Canada. We are already a leading producer of key critical mineral like potash, uranium, and nickel, and we have significant reserves of many others from lithium to rare earths. And let me tell you, we know a thing or two about mining. That's probably why 40% of the world's public mining companies are listed in Canada. And finally, we have market access. We have 15 free trade agreements and counting because we're looking for new partners. Our current free trade agreements cover 60% of the world's economy and provides preferential access to 1.5 billion consumers worldwide. This, of course, includes the best trade deal with the U.S. that the U.S. has with any other trading partners. Even to this day, despite the incremental tariffs, 85% of the trade we do with the U.S. still comes in tariff-free. And let me tell you, USMCA is not going away. It's going to be reviewed next year. As with any negotiations, there's going to be ups and downs. Our Prime Minister is currently in the Oval Office this morning, so we'll see if today is a up or a down. You never know. But mark my words, when the dust settles, the USMCA and the North American partnership will be stronger than ever because people on both sides of the border from any political affiliation understands that what unites us, that there's more that unites us than divides us, and that we're stronger together. That was the first thing. The second thing is do not sleep on Canada. I get it. The headlines about the Canadian-US relationships are not always positive these days. The short-term economic outlook may look cloudy. I'm sure Mr. Marion will talk about that in the next session. And growth has been slowing down. But as investors, you know you have to look past the noise. And if you do so, you will see that Canada has the fundamentals to rebound and thrive. The truth is, for many, many years, economists and policy leaders have told Canadian governments that we should diversify our trading partners, that we should invest in infrastructure, that we should strengthen energy security and build up our defense. But like electricity, we often follow the path of least resistance. When everything runs smoothly, essential reforms are easy to postpone. Well, today I think we can all agree that things are not as smooth as they used to be, at least 12 months ago. And that disruption as united Canadians is never before. We get it again, the world has changed, and we're carving a new path to make our economy more productive and more resilient. That's why our federal government has already removed all federal barriers to internal trade and labor mobility, and all levels of governments are moving in the same direction. The payoff could be huge. Economists say removing these barriers could add 4 to 8% to the Canadian GDP. Even at the lower end of that range, this is more than enough to offset any tariff-induced drag on the economy. We're also fast-tracking large-scale national interest projects from copper mines, doubling our LNG export capacity, expanding the Port of Montreal, to building the first small modular reactor of the G7. And that's just the first step. And if there's something that hasn't changed in the last 12 months, is that Canada remains as reliable and as stable as ever. Third thing I wanted to say to the bond vigilantes in the room who may think that, who will quickly realize that this is going to cost a lot of money, these investments, is to remember that Canada is starting from a position of strength. Inflation is back on target. We have the lowest net debt to GDP ratio in the G7. We have the smallest deficit to GDP ratio of the G7. We are AAA rated. And it's no coincidence, because for the last 30 years, governments of all stripes have committed to fiscal discipline in Canada, because we knew one day we would need that room to maneuver. We stepped up after the global financial crisis. We did it again during COVID. In both cases, Canada recovered more quickly than its peers, both fiscally and economically. Well, now, just watch us, because we're about to do it again. At a time when many advanced economies face daunting fiscal challenges, Canada has the dry powder to invest without compromising long-term fiscal sustainability. And Canada is committed to spending less and less on day-to-day operations and investing more, along with the public and private sectors, in large-scale nation-building projects that will make our economy even stronger. So there you have it. Canada has what it takes. Do not sleep on Canada. And remember, we start from strength. Thank you, and I look forward to the conversation ahead. Have a good day.
Please welcome to the stage Stefane, Marion, Executive Vice President and Managing Director, Financial Markets, and Chief Economist and Strategist, National Bank of Canada, for a conversation with Bloomberg's Eric Hertzberg.
Well, thanks very much. Good morning to you all. Thanks for doing this with me, Stefane. I think the way we're going to set this up, this conversation, we're going to talk a little bit about some of the near-term issues for Canada's economy. Then we're going to talk more about some of the sectoral, structural issues that we have to deal with over a certain amount of time.
I was told you have a bunch of cool charts that I need to speak to.
There's a bunch of cool charts. We also want to get your Blue Jays Yankee forecast as well.
Okay, I'll do my best.
Maybe we'll get to that at the end, yeah. So Stefane's prepared a bunch of great charts here for us as well. We'll get to that in a little bit. But first, I want to hear about how you're thinking about the short-term issues for the economy. We have to address the elephant in the room here. I think the tariffs are quite a significant impact. Second quarter growth was hit pretty hard.
Yeah, and when you compare Canada to the rest of the world, the effective tariff on our country versus the rest of the world is relatively low, at less than 5%. However, at the margin, that 5% comes on top of the suboptimal policies that were deployed over the past decade, and that's why it's hurting at this point in time. So uncertainty certainly doesn't help, Eric. But I am hopeful that our policymakers have seen the light on that one. And as Mr. Poirier says, we will move forward.
Great. Let's before we get on to some of these more structural issues that we're facing in the economy and these great charts, let's talk about the Bank of Canada just quickly. Yeah. What's your outlook for the bank right now? They're in a tough position. We have core inflation that remains quite elevated. The pressure on the economy is clear. Exports are taking a large hit. Investments not in a great spot. What's your outlook over the next year for terminal rate for the Bank of Canada?
Well, the Bank of Canada is actually questioning its own core measures, Eric, as you know. So headline inflation is closer to 2% or below it. So if there's one country that still has room to cut with credibility, keeping the inflation target at 2% or less, it's Canada. So they'll be cutting rates at the next meeting, for sure.
Yeah? And how low do we go in Canada? What's terminal for you? Are you seeing around 2, 1.75?
You're jumping ahead of yourself because I need to see the budget on November 4th, and then we'll have that discussions after the budget.
That's right. That's right. So let's move on here. We want to talk about some of these charts that Stefane's prepared for us here. So maybe if we can bring those up.
Actually, Eric approved them.
That's right. They got a stamp. So this is an important chart. This is one that you've prepared this. We've seen this for years, this comparison between the U.S. and Canada. I want to just talk about the structural issues that we're facing here.
For people in the room, the blue line is the U.S., the red line is Canada, right? So Mr. Poirier said there's a perception by investors that nothing ever happens in Canada. Can you blame them when you look at that chart? We've had no real capita GDP growth for over a decade, so clearly nothing's happened over that decade, Eric. So I couldn't blame investors that were shunning investing in our country under these circumstances. So people have said, we've got great people in this country. It is true. But what really impacted us negatively over this past decade, which I call the lost decade, by the way, is your following chart.
So just before we move on to the next chart, we have to address that the population growth has been very high, right? So this is a major reason we have this. It's one of the reasons why there's this big divergence in terms of this trend here. It's 10% growth over the last half decade.
No other country comes even close to us in terms of population growth. So we were able to attract tremendous foreign talent to Canada. So that should help us down the road. But it's not enough, because we've had this discussion before. That was just not a function only of population growth.
That's right. That's right. Let's move on. We can see.
Oh, there you go. You got the flags.
The flags are up.
There you go.
Here we go. This is productivity. So obviously we have a serious issue with that. And the Bank of Canada has flagged this as an emergency situation at the beginning of last year. It's often discussed.
So I cheated on that chart because I said productivity, but it's actually real business investment. So if you attract foreign talent to your shores, make sure that you have the ability to attract business investment. So when people speak to lack of productivity in Canada, they don't realize that we've had no business investment for the past decade. So that's the primary reason why our per capita GDP has been lackluster, right? As an economist, GDP is a function of capital, productivity, and labor. Labor's been great, but this is where we've gone wrong on the ability to attract private investment. You can compare that with the Americans. It's quite the divergence.
So there's a couple noteworthy points to make about the divergence here, where this trend begins. It's around 2015. Two major changes there. The Liberal government was elected, as well as the oil price collapse. What do you think is the more significant trend that's driven us or kept us flat in terms of?
I'm not going to make a political comment, but I just answered it.
Fair enough. All right, let's get into what you're looking for in terms of what's coming up. I think this is a major moment for Canada. Is this budget upcoming? Carney's first budget.
So Eric, despite these, the two top slides were gloomy charts, I'm the most optimistic in a decade about our economic outlook. And the biggest change came in April when Mark Carney replaced the former prime minister and made this drone speech that should be very enticing for me as a Canadian anyway, as an economist, pledging to be a G7 leading economy, an energy superpower, reform or reduce regulations, innovate, optimize the immigration policy. This is something we haven't seen in quite some time. So it's a major break from the previous decade.
Now, I think we should talk about regulation as well. There's a lot of push, as you've suggested, in terms of reducing some of the the regulations that may have in the past prevented some of the investment?
Mr. Poirier was making a sales pitch on Canada saying, like, we are an energy superpower, we have great people, we have a comparative advantage in many things. But you can undermine all these comparative advantage with regulations. So made in Canada suboptimal policies. And one of the best illustration to show you is probably the number of regulations that the federal government added over the past 15 years or so. We now have more than 320,000 regulations impacting our corporations. So can I blame corporations for not investing under these circumstances? In manufacturing alone, we should be an industrial superpower. Everybody wants to be one, but we have the ability to be one. But we've added more than 100,000 regulations to our manufacturing sector. So the reason I'm optimistic is with the throne speech, and just after the throne speech, Mr. Carney says, I'm ordering a review of all these government regulations. You see, it doesn't have to cost you much with the upcoming budget if you attack regulations. It's one of the neat ways where you can kickstart investment in the next few quarters.
Right. So this is one of the ways that we can do this on a less expensive manner. Let's talk about some of the more expensive parts of this. Economists that we survey at Bloomberg see a deficit upcoming of at least $70 billion. That's deeper than what Trudeau's government was running. And in the near term, the PBO has suggested that the debt to GDP ratio on a net basis will rise. This is an important shift for investment, but it may also be an expensive shift. So can you maybe talk about how you're viewing the cost of this?
Yeah, so don't give me the survey stuff. The real number on the deficit is $100 billion. So for the people in the room, don't freak out. It's about 3% of GDP, so it's still half the size of the U.S. deficit. So it's how you go about it. What do you do with that deficit? So I think $100 billion is probably the best figure to work with, largest deficit in quite a while. But I believe that this budget that we're looking at is the most consequential budget in a generation, right? Is how you convince investors to keep with the Canadian thematic, because investors own 40% of our bonds, right? So you don't want to spook them out with the budget. So this is why this budget on November 4th is so important. That's why you and I need to speak about the Bank of Canada after that, because it will be a stimulative budget, but there's got to be a big investment component that encourages investors about our future outlook.
Right. So comparatively, our balance sheet as a country on the federal level is in a much better spot. And at this point, if you started to, use some of that to fix some of these sectoral problems you've suggested here, do you think there's appetite for that when you talk to investors, when you talk to other economists? Do you think we're shifting in terms of how we feel about, for example, balanced budgets? That was always what we were interested in.
It's a great question, Eric, and to me, the important part on that is if you're going to show a deficit of $100 billion and have nothing, and introduce some measures into 2026 and not be able to grow business investment in this country, you're going to have an issue. Investors will say, you know what? It's not looking good for Canada in 2026. So this is why I say this budget is not just about showing the size deficit, $100 billion. How do you promote higher potential GDP growth in 2026? And that's been the missing link. But we need business investment to grow this potential. So I'm optimistic that Ottawa is serious about improving that outlook.
So if we look at the fiscal track moving forward, if we go from a certain if we look at where we are in terms of growth right now, we're at the rest of the year the bank's saying like 1%, for example. If we can get the growth rate back up, some of the cost of this is going to be offset in the long run if we can actually increase the potential of the economy, right?
It's all about,
our way out.
You're so right, Eric, and it's all about that, because even from a Bank of Canada perspective, you don't know what your potential is at this point in time. So with the budget, you'll be able to fine-tune that estimate, and then that will drive monetary policy. So that's why I'm willing, with conviction, to give you at least one more rate cut by the Bank of Canada, but I'm not sure that they can cut in 2026 if that budget is as consequential as I think it will be, because we will stimulate growth next year.
Right, so your view is we're going to get another cut in October, but then we need to see, the bank's going to want to see what's in the budget, just like the rest of us in terms of how we're going to act moving forward, right? Let's talk about defense here. This is a major part of what the government's planning. Maybe talk about whether this is, how much bang for the buck do we get when we start investing in defense? Maybe talk about the multiplier of that.
Well, some people, I mean, the multiplier is up for grabs. I'll tell you what the biggest multiplier, I think, where it lies. You can convince our American friends to say, like, you know what? We haven't been really serious about, playing a role in NATO for the past few years. Now, by committing 3 to 5% of GDP, some of that will go to American suppliers, some of that will be to Canadian suppliers, but this is how you make your pledge. And this is where the multiplier comes from, Eric. It's improved relationships with Americans. That is a multiplier that is very hard to seize at this point in time. But I do strongly believe that this commitment is a game changer with our relationship with Washington.
Great. So this is just, we're getting back to, comparing what's gone on in the past here. There's a lot of fear about, as we mentioned, balanced budgets was a preference for a lot of folks. A lot of that is from what happened in the 90s. You could see from this chart, we have our interest charges relative to revenue are actually, quite low relative to that period in time. You see there is this room. We have the fiscal room to do this, right?
It's the, again, this is, we do have some fiscal room when you compare Canada to the rest of the world, be it on a deficit part or a net debt to GDP. Mr. Poirier spoke to that. So there is some room, but we should not waste it. This got to be in growth-enhancing strategy. Again, I come back to that all-important budget on November 4th.
Right, so you're going to be watching closely, and I think investors are going to be watching closely as to how they plan in the future our finances as well. It's not just about the outlays themselves and the size of it, it's about where we go over the next 5 years.
Yeah, and Eric, the way to unleash growth in Canada is that we are an energy superpower. I mean, Mr. Poirier spoke to that, but we've been stranding these assets by not knowing whether or not we could exploit them down the road. And if you're going to reindustrialize, and the U.S. wants to reindustrialize, I can find no better partner than Canada. We have plenty of energy, and we have an energy grid that is not only cheap. Our electricity prices are 70% below the G7 average. Our price of natural gas is 80% below the G7 average, 50% of the cost in the U.S., and we have one of the cleanest electricity grid in the world. So if you are going to leverage this type of comparative advantage, I can only be more optimistic on Canada. For the first time in a decade, the federal government says, let's leverage this thing and show our American friends that we can actually reindustrialize and be part of this whole reindustrialization process that's taking part within North America.
So let's say, just quickly, we're going to have to finish this up quickly. I know we could talk you and I could talk for 40 minutes. But let's talk about what we're seeing so far in terms of comparison of what's going on with the stock markets.
Yeah.
There's clearly something going on here in Canada.
So already. I knew you were going to ask me about this, so I said, Stefane, how can you be so optimistic? Let me prove it to you. If you look at this table here, Canada is actually one of the best performing stock market year to date. So under these circumstances, if you're up more than 20%, clearly I'm not the only one that's getting more optimistic on Canada. I think the markets are speaking and say, well, we're optimistic on this upcoming budget and that we will deploy the growth that we should have had over the past decade. Again, we're coming off a lost decade. Again, these policies being deployed make me a lot more optimistic.
Great. So we're going to look forward to November 4th. That's going to be a big moment. We'll be talking to you then. Thanks very much for coming out to talk. And so Blue Jays, Yankees?
Blue Jays, definitely.
Great. Thanks very much, Stefane.
Thanks, Eric. Thanks for having me.
Please welcome to the stage Aida Cipolla, Chief Financial Officer and Chief Administrative Officer at Ontario Power Generation, and David Timm, Global Head of Public Affairs, Government Affairs, Northland Power, for a conversation with Bloomberg's Noreen Malik.
One more.
Welcome to the panel about making Canada an energy superpower. A lot has changed since last year, but before we dive in, I want you to give us a quick run-through of your company, just so we're all on the same page.
Yeah, well, thank you first and foremost. Thank you, Bloomberg and National Bank, for having OPG and myself here today. We're very honored with the opportunity to be here. So Ontario Power Generation, or I'll refer to it as OPG, is one of the largest and most diverse clean energy generator in North America. We have a fleet that covers very much all spectrums of the energy generation. So we have 2 nuclear power plants. They're Darlington Nuclear Generating Station and Pickering Generating Station. We have 66 hydroelectric facilities across Ontario. We also have 2 combined cycle thermal stations. Through our subsidiary Atura Power, we have 4 natural gas plants, and we're building our 5th now in Ontario. And at our Atura subsidiary, we also have a 250 megawatt battery that we're building, in addition to working on a pilot of hydrogen, where we're looking to blend hydrogen from our largest hydro station at Niagara Falls with natural gas. We also have a solar facility, and we are also here in the United States through our subsidiary Eagle Creek in 18 states, and have 85 hydroelectric facilities. So a very diverse portfolio. But one of the things that we're really excited about is leading the G7 in the first small modular reactor. And that is probably one of the most exciting things that are going on right now. But we have so many projects as we build out Ontario, including life extensions or refurbishments of our nuclear power plant. Darlington, and then now we will be entering that with Pickering. So an exciting time at OPG right now.
Yeah, definitely eager to hear more about SMRs, but David, tell us about Northland.
Well, first off, thanks, Noreen, for having us, and Bloomberg for having us here. We're very excited. So Northland Power, we're a Canadian energy player with a global footprint. We have over nearly 4 decades of experience developing, financing, constructing, and operating clean power infrastructure. We've got an operating capacity of about 3.5 gigawatts, and that's spread across wind, both onshore and offshore, solar, natural gas, and now batteries. We commissioned our first battery energy storage project earlier this year. Our business model is simple: long-term reliable cash flows, disciplined execution, and geographic diversity, which I think is one of our strengths and one of the things we bring to the market.
So Aida, when you were here last year, we were talking about energy security and costs of power. And we've now, both the US and Canada have new administrations. What does this mean for you? And we're talking about Canada becoming an energy superpower.
Yeah, I think a lot has changed since we sat here together, as I reflect a year ago. But I think one of the things, and you would have heard it earlier this morning with the 2 individuals from National Bank talk about this opportunity in front of us here in Canada, right here and right now, as we look at building out to be an energy superpower. And I think what's changed since I was on stage last year and spoke to was that the Ontario government, so Ontario, for those that might not know, about 40% of the population of Canada resides within Ontario. And so the power, we produce 50% of that power in Ontario. And when you look at that, the Ontario government came out with their integrated energy plan. And this is energy for generations. And it's really focused on how do we build out that energy security, but really how do we build out power, not only for ourselves, but for the opportunity to export. Today, we export 5% to the United States or in New York on various days. And so one of the things that we're looking at is how do we build that out? And so the estimation is 75% growth within Ontario of our energy capacity by 2050. And so what you've seen over the last couple of years is real growth. I think we all see it in every jurisdiction that we're in as it relates to real demand is there now. And for decades, we hadn't seen that. It stayed very flat or decreased as we put conservation measures into place. And so you're seeing that real demand come in, and even more as you think about the demand for manufacturing, for industrial, as we talk about data centers, and as we talk about the demand that's needed to actually fuel everything we're doing. When you lift up your cell phone and you go to ChatGPT or you're doing a search function, you need more demand for that through energy. And so when you think about Canada and particularly Ontario being clean energy and you think about our capacity to supply in low cost, it really is an opportunity for us right now. And I think that's where that provides us that long-term view as we build out our grid, not only in nuclear, but in hydro and other renewables, such as batteries, as we think through the future. And I think it's a great opportunity for us.
David, what's changed for you?
Well, I think last year, we were here. I wasn't here, but in kind of reviewing what we've talked about and what we were talking about in other rooms is, last year we were talking about the potential of Canada's electricity sector. I think today we're talking about scale, execution, and investability, speed. How do we get these projects through, right? I talked about the growth in Canada, but we're competing against growth in every jurisdiction we're in, from here through Europe and elsewhere, right? I think the global energy demand is to grow by 80% over the next few decades. So there's a strong competition, I think. And we're also seeing public sentiment evolving as well in Canada, which I think is really important, right? Where Canadians are increasingly supporting a balanced approach, leveraging our oil and gas strengths while also accelerating the shift and the investment into clean investments.
So in the US, it's all about data centers, and the biggest choke point is getting power. Is that driving people to Canada? Are hyperscalers or other developers knocking on your door?
Yeah, I think the reality here is that our borders, and we talk about how close we are between Canada and the United States, and many will say that's part of some of the assets that we have, where we have our closest trading partner right next to each other. And so the ability to think about what does that look like? Of course, data centers are coming and knocking on our doors and asking us, how do we look at that? You look at the partnerships that were announced last year with an organization like Consulate, where they're partnering with Microsoft and reopening up 3 Mile Island, and just the nature of what needs to happen across all of the technology organizations. They're partnering across the fleet, and so those discussions are happening, trying to figure out how do we work with that. The various jurisdictions across Canada are looking through and how do we support through that, and that will be part of the growth. And so I think the opportunity is in front of us, and I think right now what we need to do is really work to make sure that we can execute projects quickly, on time and on budget. And I think that's one of the key things when I look at our organization and our life extension with Darlington. That's a 10-year project. We are in year 9 of that. It was $12.8 billion that we announced a decade ago. We are in year 9. And on that project, we just announced in our last quarterly results that we are going to bring the final unit 4 of that power plant earlier than expected next year in 2026, and we are on budget on that project, including the cost of COVID and inflation that's happened over the last decade. And so you need projects like that to really bring the confidence into the energy sector and nuclear. And so I think this is that opportunity where, as we think about what can we do, it's really executing that piece will be very important for all proponents in Canada as we think about critical infrastructure build.
And David, what about data centers? I mean, they still are showing an appetite for wind, which I know you do, but you also have a diverse portfolio, and so that gives an opportunity.
Absolutely. I mean, the data center boom is real, but so are bottlenecks, right? So access to power, access to interconnections, permitting, and other pieces of the puzzle. And that, I think that this bleeds into everything we've been talking about in terms of if we're making Canada energy superpower, can we get these projects permitted and off the ground? I mean, Canada has the power that's needed. It has the potential investors to do that behind the scenes, and it has the political stability that I think makes it a prime top tier jurisdiction to hyperscale. If we can solve the grid and permitting puzzle, and I think we're getting there, right? I think the right conversations are happening, and we need to see that action continue, or move that talk into action.
What do you think are the biggest bottlenecks or choke points to making that happen? Like here, it's like finding the interconnection and then getting through that process.
We're no different, right? It's access to grid. It's can you get the power when the scale of power and the reliability of power you need? Is it affordable? And so I think it's again, Canada's no different in terms of some of the questions that are happening are being asked in other jurisdictions.
Yeah, maybe I would add on to that. I think it's also how we Canada across the provinces and territories, energy files are managed at the provinces and territories. And so the commercial arrangements with how you enter into those through a PPA or how you structure that is different. And so I think as data centers come in, we need to be able to have the flexibility based on the jurisdiction to enter into those contracts, because of course they're going to want to come in. It's speed to execution, being able to get there, and then that piece around how do you contract and bring in those partnerships that maybe we haven't done before. And I know in Ontario, we haven't thought through those types of PPAs with a third party coming in for data centers. So I think we have to be quick on speed as to we think about how do we contract those type of relationships and access, and the cost part. It's, you know, grid scale costs that come through and versus an individual company that's coming through. So I think it's how quickly can we work through that as well on the contracting side that I think will be important.
Yeah, and then making sure those are investable and financeable, right? And making sure that everyone is, that we're bringing everyone along in terms of what this needs, the difference that this brings into the business, and making sure we're all understanding that risk and opportunity and where the balance is.
Ida, you mentioned the nuclear deals in the U.S. with hyperscalers. Are you suggesting that you're looking at your nuclear plants for long-term deals with data centers too, or?
So I'm not suggesting anything. I think what I think what I'm alluding to is that the environment is different. And I think we have to really think about what data center needs, hyperscalers' requirements. It's 24 hours a day, 7 days a week, 365 days a year that they require continuous power without interruption. And so as you think about that, and you think about various types of renewables, or you think about various types of technologies, nuclear power is one of those technologies that gives you that consistent power. And so I'm not surprised at all that this is happening. I'm not surprised that more announcements won't come, and how we think through that. And I think you have to balance the need of those individual customers relative to the need and the growth of the grid. And so you have to build that out and those considerations. So I think it's a great opportunity right now for nuclear, and we talk about the nuclear renaissance that we're on right now. But it's really important. We're only as good as the last project that we did. And so that project and operational excellence is really critical to make sure that we continue to really focus in on that, to obviously entice investors, as David, you talked about, and bringing in those dollars that will allow us to do those projects.
Now, David, you have a more diverse portfolio geographically. Are you pivoting back to Canada, or how do you look at the opportunities given geopolitical tensions and?
Yeah, I mean, we've always been in Canada. I mean, we're headquartered in Canada. Our large base of our operations is in Canada. But over the last decade or more, we've focused a lot more on international growth, but still looking at what the fundamentals are, where we can get those project returns, where we can get projects through the funnel of permitting and consultations and all of the other pieces that you need to get to commercial operations. So I think we're very bullish on Canada, and I think with the demand, I mean, there's the procurements and the demand across the country. I haven't seen in more than a decade of my career. So I think we're very excited. And again, the conversations around permitting, around how do we reduce the regulatory burden on these projects, and how do we match the cycle of other demand, whether it's data centers, whether it's ISOs, whether it's just the electrification of the economy. I think it's how do we balance what we need as an investor and an operator, and what the system and the industry needs.
What is the most important piece of the Build Canada Act for you guys?
So I think it's an opportunity where I think the Canadian government has really taken a look as to what can we do better as a nation to really build out projects. And I think it doesn't matter what administration, north or south of the border, I think we all recognize that we need to do a better job as it relates to regulation, permitting. How do we go quicker? How do we really focus in bringing dollars and financing it back into, and for Canada, it's really important to be able to bring those dollars and that confidence. And so I think what this means to us is an opportunity for us to have a really close look at ourselves as a nation. How are we going to build quicker, faster, better? And I think as we think through those pieces, it's really important. And what the government has done, has announced a major projects office. They are looking at national projects of interest to identify, and it's really about expediting that process. And so what I'm really optimistic about is that there's a focus on build. It's a focus on how do we execute projects, and how do we have that really honest conversation with ourselves as to what can go faster and how do we do that. And so it's exciting. Our small modular reactor was referred to the Major Projects Office. And so what I'm hoping that comes from those is those conversations to really understand what can be done better, so we can help all projects within Canada on a go-forward basis really be able to move quicker through its early licensing, permitting, and regulation pieces. How do we entice capital? How do we think about appropriate returns and ability for that execution? And so I think it's an exciting time. I think even yesterday an announcement on the budget that will come out November 4th about a focus on projects. And how do we think about the allocation of project dollars versus sort of the operating budget dollars that are required. And so I think you're starting to see those messages, and I really hope that this opportunity in front of us, we really take and it can really take advantage of what is coming forward, because I think that's the opportunity about being a superpower in energy, but across the nation, about how do we build out jobs, energy security, and opportunities to build out Canada.
I mean, I think it shifts the conversation from whether we should build major projects to how we build major projects. And I think that's really important. It's a huge shift in mindset in the country. Now, the fundamental question is whether these signals translate from kind of policy and conversation to actual projects. I think that's where everyone in this room has is part of the conversation right now. I know. I mean, we're all trying to figure out what this means, short, medium, and long term, and whether this moves into action. I mean, Northland is not pursuing major projects. I mean, of what's been announced, but the tertiary investments, the tertiary need for new power, excites us, but it really means we really need those signals to translate, and some critical steps are still coming.
Can you talk a little bit about the signals or regulatory clarity that you want to see?
Yeah, I think there's opportunities, and I think it depends on the project. But I think when you think about impact assessments act as the duration to do those, I think there's opportunities. Nuclear is a unique element where we have our own Canadian Nuclear Safety Commission that regulates the nuclear facilities and all of our standards. And so how do we think about those two acts together, and how can we find ways to provide expediation through those processes while still following the rules and expectations? Nuclear safety is absolutely paramount. It is the #1 thing that we need to focus on. But how do we find ways through that? How do we think about opportunities for licensing, permitting, and being able to work through those pieces? So I think there are opportunities for us, and I think it's about the ability to change and hear those. And I think they'll be unique across each of the projects. And so what I'm hopeful about is that they'll take a second, see, are there consistencies as opposed to just one project's need? How do we think about this for future projects? So as more projects get announced, that there's an efficiency that happens through that, and an understanding about how can we make that effective for more projects coming through, because it will be also the small projects that we need as a nation, the medium size, not just the big ones. We need to be bringing it all through.
Yeah, I mean, exactly. But it's also stability, right? SMRs and nuclear are 10 plus years. Some of the projects that we're being offshore, what we're doing in Europe, those are long lead time investments, and so stability across the development, financing, construction, commissioning cycle is critical. So I think we need to see action. We need to see movement on kind of, we're going to break down the barriers. We're going to get permitting fixed, but we also need that. It needs to be designed in a way that remains stable across political cycles, because doing this over 4-5-year cycles is challenging and risky.
Is there an opportunity, given that in the U.S. there's a crackdown on renewables, making it more expensive? Does that give you an opportunity to build more?
I think so. I mean, we're looking. I mean, Northland has limited exposure in the U.S., so we're not as impacted as some of our peers. But I think we're seeing increased kind of competition and interest in other jurisdictions that we operate in. I think the cream is rising to the top in terms of projects that deliver returns, or have a deliverable timeline, predictable timeline in terms of bringing those forward.
Any final thoughts, Aida?
Yeah, I just think it's our opportunity right now to really execute big projects and to do it. And I think we have to focus, and I think all of us, if you're an investor, if you're a corporate, if you're a banker, we all have a place to participate in this, and government officials, of course. And so, but I think we got to do it together, and I think the opportunity's here and now, and we just need to take hold of it and really execute is going to be the most important piece.
On that note, thank you so much for joining us and telling us how Canada is going to become a superpower, energy superpower.
Thank you.
Please welcome to the stage Jim Jarrell, President and CEO of Linamar Corporation, Paul Soubry, President and CEO of NFI Group, and Rob Wildeboer, Executive Chairman and Founder of Martin Ria International, for a conversation with Bloomberg's Melissa Shin.
Wonderful. Thank you again. Hello again. And thank you all for joining us coming up to New York today. Well, it's been a really boring, quiet year in Canadian manufacturing, right? Just nothing's happened. Oh, no, I'm just in. Oh, yes, tariffs. Right. Well, before we dive into that, why don't each of you just give us a quick, what is your company, what does it do, and a breakdown of your US, Canada, and global markets.
Start with myself?
Yeah, let's start with you.
Yeah, so Linamar is about a 60-year-old company. It was founded in Guelph, Ontario, Canada. 34,000 teammates. We're in the mobility sector, we're in the ag sector, we're in the construction sector, and about $10 billion in revenue.
Okay, and the breakdown between U.S., Canada, and...
I would say the majority, probably about 70% would be Canadian, would be our breakdown, and then we would have about 10-15% U.S.-based.
Gotcha. Okay, how about you, Paul?
Hi, Paul Soubry from NFI Group, headquartered in Winnipeg. We are North America's largest bus and coach manufacturer, so we're serving both public customers and private operators. We've got about 9,500 people. We do close to $4 billion US in revenue, and about 75% of our revenue is in the United States, and then about 10 in Canada and 15 globally.
All right, and Rob?
So Martin Ria, first day was September 10, 2001. So we had an interesting second day. We've grown from about 0 to 5 billion Canadian in sales. We have about 85% of our sales in North America. To give you a sense of the split, about 2,000 people in Canada, about 4,000 in the United States, and over 8,000 in Mexico. So we're very much North American oriented, but operations in Europe. We're mainly an auto parts manufacturer. We do lightweight structures and propulsion systems, steel, aluminum, fuel and brake lines, and so forth. And very glad to be here. Thank you.
Yeah, thank you so much. Well, as you can hear, there's a definite integration between Canada and the U.S. with manufacturing. And of course, with the advent of Trump's tariffs, this has been quite the interesting and challenging year. But we also have a little something that you guys probably call CUSMA, but we call the USMCA here in the U.S. And so how has that framework affected your businesses? Jim, we'll start with you.
Yeah, it's been a challenge, and the challenge changes like almost every single day, every week. Again, like from a Linamar perspective, we've sort of come at this, I guess the way we've been saying it is this time has been a business person's nightmare, but an entrepreneur's dream in some ways, and you need to be able to pivot, be flexible, and really adjust as you go. But again, we probably learned way more about HS codes in the last 6 months than anybody would ever want to even think about. And again, how we adjust to each one of these has been something we work as a team. And really, the latest derivative tariffs have had a real deeper impact on the complexity of what we're producing and selling. And it gets a little bit more complicated because now you're down to melt pour weights and trying to adjust to pig iron, cast iron, and it's just very, very complicated. So again, it's a day-to-day issue to monitor.
Right, so the sectoral tariffs have had quite an effect. But when you're moving parts around under USMCA, how does that sort of give you an advantage?
Yeah, I think again, one of the key things, as I said, it's like an entrepreneur's dream. And if you look at the mobility sector, onshoring is a big topic. Actually, I was mentioning to somebody yesterday, and Rob knows this, we have a sales program we created called MAGA, right? And that's Make Canada, Mexico, America Great Again sales program. And that is basically onshoring, because I do believe that all three of these nations have to get it together and will get it together. There is no other formula long term, I think, for our North American side. So I think we have a lot of, negotiation tactics going on, but I think at the end of the day, we need to get unified as a North American group.
Gotcha. And Paul, it sounds like you have quite an exposure to the U.S. So tell me about what things have been like.
The vast majority of the business is public funds, so federal funds or state and local funds. And so inherent on using the federal funds, there's a Buy America element. So our supply chain has always been primarily U.S. oriented, whether we're building for a U.S. customer or a Canadian customer. And as Jim mentioned, the dynamic now of having to know 2, 3, 4 levels down in the supply chain of what makes up those parts that we buy. The other uniqueness or challenges from when we bid to when we build can be 12 to 18 months. And so you kind of got a little bit of handcuffs on in terms of the ability to resource, given the Buy America dynamic. The other unique part of our world is the vast majority of elements that go on a bus are spec'd by the customer. So when the customer says use Bob's seats or Fred's windows, our ability to pivot there is very difficult. Having said that, what we've tried to do is work integrated with that supply chain dynamic, but we're expanding the Canadian capability. So what we'll do is source where we source. We'll build in Canada for Canada. We'll build in the U.S. for the U.S. So it costs capital to do so, but we think for the long term we'll be far more insulated from any of these incredible shocks that go up and down.
Sounds good. And Rob, how have you seen demand change over the past year, ever since the tariffs were announced?
Well, demand's been pretty good, but let me tell you where I think we're going to get to on USMCA and why I'm optimistic about it. And so there's 5 aspects to it. The first one is we've got to work to a place where there's no tariffs on parts or cars in North America. It's kind of silly in the context of that, and I think we'll get there. I think Canada and Mexico have some trading chips that they can do to get there. The fact is that an assembled vehicle in Canada has over 50% U.S. parts, and it's similar in Mexico. So we are different than Japan and Korea and so forth. The second thing, the U.S. has pushed for higher rules of origin. I think they're right. I think every supplier thinks they're right. And the OEMs don't always agree with us, but the OEMs at the end of the day will do anything for a cheap price, including import from China. And I think the U.S., that's a bugaboo, and I think they're right. The third thing is there has to be a higher penalty for not complying with rules of origin. Right now it's 2.5%. If it's 25%, those rules of origin have teeth, and so I support that too. The fourth thing is I do think you need to have tariffs or quotas or something on what comes from Europe, Japan, and Korea, because at the end of the day, that will encourage them to make more here. Just to give you a sense, we sell 19 to 20 million vehicles in North America every year, about 16 in the U.S., close to 2 in Canada. We buy a lot of cars in Canada, a lot of trucks, 1 to 1.5 in Mexico. We only make 15 million. That's 4.5 million. So if you could get another 2 million built by European, Japanese, and Korean suppliers here, that's 10 assembly plants. That's huge, huge production. That's exactly what the U.S. wants, rather than taking 50,000 vehicles from Canada, trying to get 2 million from Europe. And then the fifth thing is you got to keep China out because they cheat. And so at the end of the day, that means their parts, that means their cars, that means their investment, because in our industry, and the USMCA is primarily an auto pact, and a lot of people are jumping on it, you have to, in essence, recognize that Chinese investment is displacement. We've seen it in furniture, we've seen it everywhere else. So I've been arguing this for a number of years. 3-4 years ago, I looked like a Martian. But that is U.S. policy. That is Lighthize's policy. We're seeing it in Mexico. We're seeing it in Canada. If we do that, I think we're going to get there. And the other thing that was talked about, there are a number of things that Canada can do and Mexico can do to effectively create a better relationship. It's not just about tariffs and trade.
Right. And of course, Mark Carney is in the White House today, and we're thinking about whether or not USMCA will be renegotiated and how. 2026 is sort of that deadline. When you're looking forward, Rob, to the next year ahead, how are you modeling for a potential time when perhaps USMCA changes?
Well, I think it's going to be renewed. The messaging I'm getting is the White House isn't saying they're going to tear it up. It was very interesting. I was in the White House the week after the tariffs were announced on auto talking with Kevin Hassett, a very smart guy, doesn't know anything about manufacturing though. And I said, do you realize that if you put tariffs on parts on February 1, the industry would be shut down by February 3rd? I mean, we could do it ourselves. No, why is that? So anyway, that was the discussion then. Then when Carney visited the White House back in May, a number of Canadian CEOs, and I'm not a CEO, I'm executive chair, my American partner's the CEO, we had a good discussion with Besant, and I went over this 5-point plan with him. He said, I agree. And he says, we've come to the conclusion that tariffs on parts are a really bad thing. And I think that's true. And you can look at that. It's not just automotive and transportation, but we have to essentially go look at the facts, negotiate, and so forth. And I think we're going to be fine. The other thing I would say is Mexico has come a long way. They have they've been playing the fence a little bit on China for a long time. And in the last month, they announced that they were aligning with the United States on China, which I think is extremely important.
Okay.
A good example of what Rob just described, and on a parts basis, a camshaft forging we buy out of Mexico. We ship that into the U.S., which gets processed. It comes to Canada, that gets processed further, goes back into the U.S., gets finished processed, and then that goes into a transmission plant in three different countries. So when you think about this cross-border, calculation of parts crossing back and forth, it is like an omelet. You cannot scramble this thing, right? Like it just doesn't apply, right? So to me, I think Rob's dead right on this. You got to have the free trade on the parts because it just doesn't work.
Yeah, we make things together.
Yeah,
that's just the way it is. And the benefit of that is the consumer, including American consumers, all of whom are voters, get better vehicles at better prices.
Yeah, fair enough. And Paul, Rob had quite a list of things that are important to him to see over the next little while. When you're thinking about revitalizing Canadian manufacturing, what are some of your policy recommendations?
Well, in our business, the vast majority is Buy America driven, right? Which requires two things. One is final assembly in the United States, and the other is U.S. content. So USMCA has been fundamental to us in terms of being able to move stuff back and forth. And I do agree with Rob and Jim that has to be critical going forward, that ability. But our world is not like what Jim described of stuff going back multiple times. We buy something, we embed it, we may send a vehicle to US or into Canada. The stability around tariffs, in our case, the vast majority of our customers are public customers. So in reality, the government tariff is paid for by the taxpayer, which is, just effectively an inflation on themselves. And so the reality of being able to work to be able to pass that on, but also to educate people around the ultimate cost is going up, just like in a retail sector where the customer is actually paying the tariff. So stability around tariffs, whatever they end up being, is critical going forward, whether it's tariff between Canada and the United States, or many components that we buy in the U.S. have international components or elements to them that come into the U.S. Stability around that would be fundamental to competitiveness on both sides of the border going forward.
Gotcha. And have you ever encountered, I know you say that you are, you're doing the final assembly in the U.S., and so is there anyone that says, hey, wait a minute, you're a Canadian company? Like, does that ever come up?
No, we don't have that because, we have twice as many people in the United States that we do in Canada. And at the end of the day, the sourcing of the material is U.S. origin and the people are. There's once in a while you'll find somebody that, from a procurement perspective, they say that's a Canadian company, but we bid as a U.S. customer, as a U.S. supplier in those environments. And at the end of the day, the bad news around the whole hyperinflation dynamic and COVID and supply chain dynamics is many of our competitors are gone. So quite frankly, today I only have one competitor in the U.S. and one in Canada. So the table has turned in terms of who has leverage in terms of purchasing, sourcing, building, and assembling for a customer.
Right, and I mean, buses will still be necessary.
Well, the good thing about us is, unlike many other things in our world, buses are not going away. A city bus may change size and shape and color and propulsion system and whatever, but buses are not replaceable. They are the backbone of every city in North America, in the world for that matter. And intercity coaches are not going away. They'll change in those elements. You can't replace them. I mean, anybody that lives in Toronto or any other city that watches to try and extend a subway system or put in light rail is $10 kajillion over 20 years, and then it's over budget and overextended. You can dynamically change a part of a city with public transit, with buses tomorrow. So it's quite a really exciting place to be.
Fair enough. Jim, how are you seeing Canadian demand versus U.S. demand for your products?
In the industrial side, we're probably in a down cycle on both the construction and the ag sector. It's hard to understand if that's related to the tariffs. I'm sure it has some impact. That would be one of my key worries about, eventually this tariff is going to have to hit some demand level. But the mobility, as Rob said, has been pretty stable. And I think that's good. In regards to, manufacturing, our perspective on that is, it's important to note that we don't look at Canadian manufacturing as a place that is struggling. Actually, quite frankly, our operations in Canada are probably one of the best running, efficient plants that we have on all the metrics, contribution, uptime, mean time to repair, you name them. There is a lot of great synergies that are there today. But eventually, I think, for all of us in Canada, we are under some siege of the manufacturing sector. And I think we got to create some partnerships, be like Martin Rea, and obviously all of us here need to find partnerships be big brother or big sister for some of these smaller companies that they can succeed, create relationships with universities, and get the government really, and we were at the Stephen Harper last night and he highlighted some of this, really reducing the regulatory issues in Canada to make us ability to move way faster, provide the incentives for innovation and really to get a workforce team that we can develop for the future.
Okay. And Rob, in terms of markets other than North America, what are your thoughts on potentially diversifying outside?
Well, we've been very careful about China. I'm a bit of a student of geopolitics, and I said we put too much in China. It's going to blow up in my lifetime. It's doing that now to a certain extent. I think Europe is a museum for history. There's opportunity, but at the end of the day, I think there's huge fidelity in North America. And I do think that, the United States is blessed with the 4 best neighbors in the world, the Atlantic and the Pacific, Canada to the north, Mexico to the south. We do things extremely well in Canada, very talented. You take a look at the auto parts industry, 3 of the fastest growing auto parts companies in the world have come from Canada, Linamar, Magna, and ourselves. We've grown from about $15 billion in sales in 2001 to about 75 today. We've done a lot of, I've bought a lot of bankrupt U.S. companies in the context of that, and we do things really well. The thing that I would say in terms of the whole reshoring and manufacturing, U.S. doesn't have enough people, folks. They just don't. And so at the end of the day, you need to take the resources of Mexico and Canada in order to do some of this stuff. That is just a reality. It is very hard to open up a plant. We have operating plants from Michigan down to Alabama. We know how to run plants. We're the first or second largest employer in every community that we're at because we tend to be in more rural communities. And at the end of the day, we are a solution to the United States. The one other thing I'd say is that, there's a lot of talk. Canadians and Mexicans are upset with some of the rhetoric that comes from the United States. But a lot of the criticisms that have been placed on Canada, and we saw it with the first speaker, are absolutely correct. Our border used to be the envy of the world, and we blew it, right? We opened up our border. We've got to fix that. We're soft on crime. I have 2 brothers that are retired cops. They've been telling me this for about 30 years. We have not protected our Arctic. It's our Arctic. We will protect it. We don't need the United States to protect it. That's why we're spending the money. We have to spend more on military. We have to unleash our energy and get rid of our interprovincial trade barriers. And I think I really do believe that the 21st century belongs to North America, but it also belongs to Canada. We have more natural resources per capita. We're the richest country in the world per capita in the world, other than some small Arab states that have a lot of oil.
Okay, bullish on Canada. Paul, what do you think about international expansion?
So our product, what we deliver, design and deliver, is very unique in each of those countries or regions. And some of it has to do with Department of Transport regulations or safety regulations, as well as climate. So the ability to build a bus in Winnipeg and ship it to Singapore is not going to happen. So what we've decided to do is focus largely on Canada and the US. And we have selectively acquired outside North America. So we bought the world's largest double-deck maker based in Scotland and England, with facilities in Singapore and Hong Kong. And we do use some Chinese build partners. So we'll design, source, and have somebody build it to ship to that region. But shipping globally from where we live doesn't make any sense. The other offset of that, which is quite interesting for us, is we live in this little bubble in North America around certain levels of technology. By playing internationally, we're learning about competitive strategies and dynamics, the Daimlers, the Volvos, the MANs, and so forth. And so we're able to be the beneficiary of know-how, technologies, and so forth that we can actually bring to Canada and the United States and deploy. And so part of our dynamic is the propulsion shift from diesel, natural gas, battery, hybrid electric, to battery electric, and now fuel cell. And it's not a light switch. It's a progression, and every situation, every politic, every geography has different dynamics. So we made two decisions. We would offer product that had any propulsion system, so the same envelope. So in New York City here, we have diesel, we have natural gas, we have hybrid electric, we have battery and and fuel cell, all in the same envelope. And so there is that. The other issue is we build them all in the same production line. So by definition, you have volatility of labor and material and working capital inefficiencies, but you have infinite flexibility to build based on what the customers. And we sit here today with something like a $15 billion backlog, so almost a 3 to 4 year backlog sitting. So we're at a pretty unique place in that environment, notwithstanding the turbulence of tariffs and USMCA today.
Okay, some hope. And Jim, it seems that Linamar has sort of been a surprise winner from the tariffs. There's the USMCA has really helped your business in some ways. Is that fair to say? Tell me about that.
I would say that we've held our own with it. I wouldn't say we benefited from the actual tariffs. I think it's been very difficult. A challenge for our employees. It's been a challenge. It does cost us, of course. Again, we from our strategy, we're not going to do anything that we regret. Meaning, we're not going to shut down plants, move plants around, and all those type of things. We are very focused, region for region. We've always had that strategy. You produce in the region that you're selling to your customers in that region. The advantage to us, I think we have a good balance sheet today, and there is a enormous amount of distressed industry going on globally, and it's different per region, but there's a lot of difficult situations going on in Europe that we can assist our customers with, so we will definitely keep focused on that.
Okay, sounds good. Well, we have about a minute left, so I'm going to ask each of you, if you were in the White House today hanging out with Mark and Dawn, what would be your message?
I've spent time with Mark, not in the White House. I think he's an adult in the room. I don't think we've had that the last 10 years. I think that he's very technically solid, and I think that, going through the facts and so forth, we're going to be okay. A bad negotiation is worse than no deal. So I don't expect a deal, but I do expect progress.
All right, Paul?
Very much the same. At the end of the day, I too have had an opportunity to spend time with our Prime Minister, and it is about the right deal, not just a quick deal. And so I think he's equipped, and I think he's capable to get us the right thing for the long term.
Jim?
Yeah, I would say we need to make a deal. I know we have to make the right deal. I remember after the election happened, and my family would say, "Dad, settle down, just settle down." I was like, Prime Minister Trudeau should get on a plane tomorrow, call up Wayne Gretzky, get the son-in-law Dustin, go play a golf game down in Mar-a-Lago, and come up with a creative deal, because this is what we have to do tactically long-term. It's like one of us with our biggest customer, right? We have to make a deal. Yes, long-term we can diversify, but that's down the road, and so we do need to make a deal with our friends in the U.S.
All right, well, fingers crossed. Thank you so much, all of you, and thank you.
Please welcome to the stage Louis Veyronneau, Chief Operating Officer of Atkins Realis, for a conversation with Bloomberg's Derek DeCluet.
Louis, thanks very much for joining us and being here in New York. Atkins Realis, as many in the audience know, is an important player in civil engineering and in the nuclear business, which we're going to get to. These are hot areas for discussion. But first of all, I want to ask you about your return to the company. This is your second go-around at Atkins Realis. You spent some time in the pension world in between. And as you return, you're responsible for, among other things, M&A. So what does the acquisition environment look like right now in the engineering space? And what are the capabilities that the company is looking for?
Well, first of all, thanks, Derek. It's always good to be back in New York. Good to see you. This is week 7, so I'm going to give you in-depth perspectives. It's an interesting time in the engineering space. So as you know, it's a very fragmented industry, which probably will go the way of most industries and gradually consolidate. What we're seeing right now is there is a lot of M&A activity. We also have private equity funds that are coming in and trying to sort of roll up, which is going to be interesting to see, frankly, because typically engineering firms are not that easy to integrate. So if the private equity firms do the real work of actually integrating, then you get, rather than having small-sized firms, you're going to have medium-sized firms that can then be joined into the majors. If they don't, and they just do a bit of fancy engineering, then what we'll have is companies that look big but are really fragmented and will require a lot of integration. So I think it's an opportune time in the market. Multiples have been going up, which is never helpful when you're a buyer. Helpful if you're a seller, but I tend to be on the buying side, so I take a bit of a break on that. The company itself is in a great position. As you saw, we've paid down debt. We sold the 407 north of Toronto for $2.6 billion to reduce debt on top of that by another $900 million. Our stock price is not bad, as everyone who always comes on stage also is still underpriced, but obviously. But I think we have a currency with which to deploy in acquisitions. I think if you look at the way our company is set up, we have essentially pretty much the full spectrum of capabilities, but we don't always have the full spectrum of capabilities in every jurisdiction. So our M&A strategy is going to be one primarily of being very disciplined, tuck-in acquisitions, and tuck-in, the definition of tuck-in can vary, but essentially trying to close out geographical white space. The David Evans acquisitions was an example of that, where the U.S. Northwest was an area where we had less presence. Post David Evans, we have a better position, and that allows us to leverage the full capabilities of the firm wherever those capabilities may sit, servicing clients in the Northwest.
So it's been a theme already today, is government spending, infrastructure, the kind of some of the big themes driving things this year. Military spending, a lot of this activity is happening in the markets where your company operates. So what can Atkins Realis do to get involved? What are the areas where you'll play, for example, in military and infrastructure? What are the areas where you won't play?
So great question. So one thing is, and I think part of the reason why we're hearing a lot about infrastructure, infrastructure and defense are somewhat related, right? So maybe I'll start by explaining why there's a relation. So people have focused, for example, in Canada, on the message of we're going to actually meet the 2%, then we're going to exceed the 2%, and we're going to go to 5%. But the real way to think about it is we're going to go from 2, or 1.4 to 2, 2 to 3, and then the 3 to 5 is essentially military adjacent things. So it is infrastructure, it is making sure that your power grid is secure. So there are elements there of resilience, there are elements in there of cybersecurity. which count in the 5% as it's defined, right? In terms of pure infrastructure, so Canada has a deficit of about 360 billion Canadian dollars so if you look at what we need to spend just to have the infrastructure in the shape it should be. Put it this way, our highway system was designed in the 50s, 60s, 70s, so all of that is coming due, if you will. So the rule of thumb usually is if something is true in Canada, it's true times 10 in the US. In the US is about 3.7 trillion US dollar deficit, and in the UK is about twice as big as Canada, so you're talking about 725 billion pounds of infrastructure deficits. All of that needs to be built better than it has been, needs to be built with different standards of resilience as well. One of the elements of resilience is the climate patterns are changing, so you do need, a good example is you don't build a storm sewer today the same way you built a storm sewer 20 years ago because the way the rain comes down is very different, right? So you have to adapt for that. And in that, you also have to adapt when we think about the power infrastructure, for example, we are in a world that is a bit more unruly, where you do get all sorts of aggression, cyber attacks or whatnot, and you do need to protect against that. So for a company like ours, so obviously civil engineering is something we do, but our range of civil engineering is quite broad, right? So we do, well, obviously we'll do, we'll talk about nuclear, I'm sure. But we do power grids, we do roads, we do bridges, we do cybersecurity. We are giving advice to some governments on their cybersecurity needs, their resilience needs. We are helping with disaster relief in the United States. All of that is sort of playing to strengths that we have, right? On the defense side, obviously you think about, we're going to need submarine pens, we're going to need air bases. But we also work, for example, we help with the maintenance of some Royal Canadian Navy vessels, and we help with the maintenance of some British Royal Navy vessels as well. So if you think about something like the AUKUS deal, there's something where you have British technology helping Australia. That is something we can play a role. So our remit is actually quite broad. Right?
Let's talk about AI for a moment. It's having its impact, early days yet, on all sorts of industries. What sort of impact do you see it having in the engineering business? How do you think AtkinsRéalis might use it?
So I'm gonna break down AI into 5 different buckets. The first bucket is, I would say, we always have to be careful. There's a lot of hype out there, right? So you have a lot of people who are some of our peers, but companies in every industry that are talking about their AI noose. And sometimes what you realize when you dig down is that means they're using Microsoft Copilot in the office, right? So that's not quite impressive yet. So remove the hype for a second. On the corporate side of things, I think there is vast potential for AI to help us be more efficient on, I'm going to say, the HR side, the finance side. So a lot of back office functions, frankly, the wind work side as well. So it allows us to, to me, AI is, like, the key point is, how do you industrialize? How do you automate? And what part does AI play into that? So AI is sort of the end of that chain, not the beginning of that chain. So there's always room to industrialize further your back office functions, I'm going to say, and create efficiencies that way. We at AtkinsRéalis have gone through, in my past incarnation, we went through quite a bit of a transformation program and took out quite a lot of costs, right? So that is never ending. You always have to look at your costs every day is a new day. But I'll give you a good example of a tool that we use where you can come into a building site and with your phone sort of scan with your camera, and then we have an AI tool that will identify safety deficiencies. Does that replace the operators on the ground doing the right thing? No, but does it help them? Yes, it does, right? So I think that's a good, useful way to think about AI. When you turn it into on the engineering side, one of the big concerns is always on the engineering side, and we all drive on roads, on bridges, we all live in buildings, and some of us may live close to nuclear reactors, so you'll be thankful for this. In engineering, quality control is very important. You do need to have an engineer that can trace it all the way back. So to say, well, congratulations, Derek, your new bridge has been entirely designed by AI following an algorithm that we're not sure about, but it's going to be fine. That obviously wouldn't work, right? So if you think about how AI probably develops in engineering, it's probably more a blue team, red team issue of you have your team of engineers building and designing the way we're used to. Again, there's automation and there are tools that accelerate the work. What you can have is a red team that's the AI that's saying, okay, how would you design the bridge? And then that allows you to compare and contrast and make sure that you haven't missed anything, or make sure that sometimes the AI may come up with an interesting twist. And you can then reverse engineer that twist. But what you can't have is to say, there's an algorithm, I don't know how it was trained, but it sort of designed it this way. So that's I suspect that's gonna mean that adoption has to be very controlled. And within AtkinsRéalis, we do have some pilots to make sure that we are controlling how it's going. The last 2 points I'll say is on the service side. Again, we are advising, for example, the UK government on their AI approach within some ministries of the UK government. So obviously, as there are more things AI, our services are being requested. And the last bit, of course, is on the nuclear side. We think that right now in the U.S. there's 11 gigawatts that is being used just to power data centers, and that's expected to be 42 gigawatts in 2030. So Aida was mentioning a bit earlier. Obviously, whatever you do with data centers, so a query using artificial intelligence uses 10 times more electricity generally than your normal Google search. So all of that also for us, there's also a bit in there, which is, well, you need power to power these things. And thankfully, that's something we know a bit about.
Yeah, well, it's important that we talk about nuclear because that is a differentiation point for AtkinsRéalis. You actually own the technology. How far can you go with it? How much potential does that business have? Well, yeah, what can you do with it?
It's exciting times, very exciting times. So our backlog on nuclear is up by 223% year over year, which is in any given year, that's a good number. If you think about the way we were thinking about nuclear, but a few years ago, we were thinking about there was a lot of decommissioning work. So right now, decommissioning is still one thing we do. We're decommissioning Sellafield in the UK. The thing that has come back is extension. So we're extending the life cycle of Darlington, Pickering, and Bruce Power in Ontario. So Aida mentioned a few of those. Qinshan in China, Cernovoda in Romania. So those are extensions. So again, back to, if you think about a few years ago when Angela Merkel then announced Energiewende in Germany and saying we're going to move away from nuclear, well, to some extent, I would say we now have an Energiewende 2.0, which is we're shifting back to let's bring back the nuclears. So extension of existing plants. We have a new can-do in Cernovoda as well. That's on the go. We have other builds using different technologies, Sizewell C, Inclay Point C in the UK. So there's going to be a lot of new builds using various technologies. And again, we do own the can-do technology, but we also work with other technologies as well. One challenge that we're going to face as an industry is, if you think about it this way, in the 40 years of the first nuclear phase, 112 reactors were built in the United States by 4 OEMs. The plan right now is calling for 300 by 2050. So there's going to be a lot of demand there. So I've covered decommissionings, I've covered life extensions, I've covered new can-dos, I've covered new reactors that are not can-dos. We're also developing Monarch, which is sort of the next iteration of the can-do technology. On top of that, we are involved in several SMRs, small modular reactors. And we are also supporting some clients on their work on fusion reactors. So I don't think fusion is for tomorrow, but there is already engineering work that is being done and that we are helping ITER in France and Princeton in the US with. So I think it's a broad spectrum because we will need all of that to actually get to the solution.
All right, we're going to bring you back in 2050 to see how we did on building 300 new reactors.
Yeah, indeed.
We've reached time, so thank you very much for joining us today.
Thank you.
Please welcome to the stage Scott Burrows, President and CEO of Pembina, Eileen Maricar, Senior Vice President and Chief Financial Officer of Keyera, and Vern Yu, President and CEO of AltaGas, for a conversation with Bloomberg's Joe Ryan.
Well, good morning, everybody. I'm Joe Ryan. I run the energy team in the Americas for Bloomberg News, which covers oil and gas production from Alaska all the way down to Argentina. And as you've heard today already, Western Canada is blessed with an enormous amount of natural gas. But to bring all that fuel to market, you need a tremendous amount of pipelines, storage tanks, and other facilities. And we call that stuff the midstream. And it's the midstream because it is between the wells, which is the upstream, and the refineries and the distribution stream, which is downstream. And the environment to develop midstream infrastructure in Canada has shifted significantly in the last couple of months under Mark Carney. So we've got three terrific guests here to talk about that. Before we launch in, let's just hear a little bit about their company so all of you know where they're coming from. Scott, can you tell us a bit about Pembina?
Sure. I'll try to be brief. Pembina, as you pointed out, is a Canadian midstream company with assets that span all of the commodities, crude oil, natural gas liquids, condensate, and then a growing LPG and LNG export business. For Pembina, our assets mainly consist of 6.7 BCF a day of gas processing. We ship over 2 million barrels a day of crude oil and NGLs and condensate. We have over 20 million barrels a day of above ground storage. And we have a $4 billion backlog which we're currently executing on, including our flagship Cedar LNG project.
Got it. And Eileen, can you introduce us to Keyera?
Sure. Keyera is, we would describe ourselves as a natural gas liquids infrastructure company. Really, we process the natural gas and we extract the higher value natural gas liquids. We then have the infrastructure to store, transport, and ultimately market the end products. That's what we refer to as our integrated value chain. We primarily handle propane, butane, condensate, and we also produce a high-value gasoline blending component called isooctane.
And Vern, could you tell us about AltaGas?
Hi, AltaGas is a diversified energy infrastructure company. We own 4 gas utilities in the United States, providing American gas to American customers. In Canada, we have a fairly significant midstream business where we're primarily focused on exporting natural gas liquids to the best market for that product, which is in Asia. And we export the lion's share of that product from Western North America.
Great. Eileen, can you kick it off and tell us a bit about the midstream needs in Western Canada and how they fit into the nation's growing role as a global energy supplier?
Yeah, absolutely. I think maybe I'll start with some context. So Canada is, we produce more hydrocarbons and NGLs than we consume domestically. So we are a net exporter, exporting market. And, you know, our energy is among the most abundant, meaning we have lots of it, cost competitive, and responsibly produced in the world. And, you know, what has really constrained our ability to move that product to global markets has been the lack of egress or takeaway capacity for decades, for a very, very long time. And what that resulted in is our customers or the upstream producer was really receiving a price that was at a deep discount relative to the international benchmarks. So now, you know, over the last 2 to 3 years, that has really begun to shift and change. And we are unlocking our ability to move that product to global markets. So with LNG Canada, you know, beginning to ramp up exports off the West Coast, with the Trans Mountain pipeline expansion that came on in 2024, that has unlocked egress for crude. And then, of course, the export infrastructure that is being built by my fellow panelists here or has been built as well.
So that has significantly helped to unlock some of those constraints. So as we kind of look at the future, I'm really excited about the future of Canada and the role we have to play. I think for the first time in a very, very long time, the country is getting aligned on the need to position ourselves as a global energy leader. And by that I mean there's improving public sentiment, there is more alignment within industry and government. We have a lot more to do to get there, but I think we're starting to see significant change on that front. So when it comes to midstream companies, assuming the returns are there, we are ready to invest in the infrastructure that is required to support that growth and to connect our energy to global markets.
And Scott, how has the regulatory environment begun to shift since Carney took office?
Well, I would say from a tone perspective, it has shifted. I think we've seen really positive tone from the federal government. They obviously came out with their Bill C5, which is going to fast-track nation-building projects. As of right now, there's one project on that list that really impacts the three of us here on stage, which is LNG Canada Phase 2.
And C5 is the One Canadian Economy Act.
Correct, and that's helping progress. But unfortunately, LNG Phase 2 was already in progress and was advancing, and so I think what we'd really like to see is to get incremental projects on that list. And what you've seen recently is the government become a proponent to try to move that a new crude oil pipeline from Alberta to the West Coast. And I think to me that signifies a little bit of industry's still hesitation with what I'll call the last 10 years. And so what I've found fascinating is it really is a chicken and an egg problem. The government came to power and they reached out to industry and said, bring us projects and we'll help advance them. And industry said, well, we haven't really been working on them for 10 years because there wasn't the environment to do that. And so I just think both sides need to be patient with each other as we continue to advance. And that's on, I'll call it the major projects. In the background, we still need to see things like, okay, you have a crude oil pipeline, but if you have an emissions cap and you have a tanker ban, if you can't fill the pipeline or empty the pipeline, what's the point of building a pipeline? So there's still things that need to be sorted out. And then just day-to-day regulation, we still see, compared to provincial regulation, the federal regulation is much more stringent, takes much longer, more complex. And so I still think there's work to do there. So I guess overall, I'm optimistic, but we still need to make some progress on some of the regulations.
Got it. And one of the things that the Carney administration done is opened a major projects office. Can one of you tell us a little bit about that and whether or not you think it'll move the ball?
Well, that's really to help shepherd Bill C5 and how they're going to execute the projects. I think for our industry, there was some very clear signs. Number one, it's headquartered in Calgary. Number two, it's headed up by Don Farrell, who was the CEO of Trans Mountain and really got that pipeline across the line. So industry experts based in Calgary, to me, that sends a real signal that Bill C5, while it's a One Canadian Act and it's going to look at all industries, there will be a focus on the oil and gas business because we know that's what's going to drive our economy.
Got it. Vern, your company has a significant footprint in both the U.S. and Canada. You own utilities in the U.S. You were involved in the Mountain Valley Pipeline development. Can you tell us a little bit about the differences between regulation for infrastructure projects, both north and south of the border, how they're similar, how they're different, et cetera?
Well, I think, Joe, that there's been difficulty with infrastructure both in the U.S. and Canada for the last decade or so. Depending on where you are in the U.S., regionally it can be very challenging to build infrastructure in the U.S. just as it is in Canada. The great example you mentioned is the Mountain Valley Pipeline. It took 10 years to get permitted and built. I think in the U.S., the president is working away on trying to streamline permitting, and in fact, the National Petroleum Council, which I'm a member of, is working with Secretary Wright to see if they can fast-track projects. Scott mentioned the Major Projects Office in Canada, which is the first step at looking at how do you improve permitting in Canada. But ultimately, in Canada, there needs to be a clearer path and probably the repeal of several pieces of legislation to give project proponents the certainty and the legal status to pursue major projects. So again, it's depends which province you're in, which state you're in, the speed you'll get permits. We operate a gas utility in the Washington, D.C. area where we operate in the city, Maryland, and Virginia, and they're all within 20 miles of each other. And the jurisdictional permitting between those three states is going to be massively different, which is no different than BC, Alberta, and the federal regulations we see in Canada.
And Eileen, you're nodding your head in agreement there. Is there anything you want to add?
No, other than you're right, we have a lot of work to do to repeal some of the policies that have been put in place over the last 10 years. But, you know, we're at least starting to make progress in that right direction.
Got it. Yeah. Is there anything significant that you think one country could learn from the other in terms of, you know, something that is being done well in the U.S. that perhaps you'd love to see done in Canada or vice versa?
Well, in the U.S., the companies generally have the ability to move their projects from state to state, region to region, to take advantage of faster permitting. You'll see that U.S. infrastructure companies will primarily focus on Texas and Louisiana, where things can get built quickly. Unfortunately, in Canada, the resources are in Alberta and parts of BC and are landlocked and have to go through other provinces to make things happen. So we don't have that structural ability to move capital and projects around.
Got it. Let's turn to LNG, which is liquefied natural gas, and it plays a big role in bringing Canada's energy to the rest of the world. Scott, you guys have a project in the mix. Can you tell us a bit about Cedar LNG?
You bet. It's a 3.3 million tons per annum floating LNG facility. And what's unique about this project is that it's the first Indigenous-owned, majority-owned project in Canada. So we have a partner on the project, Haisla First Nation. They own 50.1%. We own 49.9%. So true governance rights, true board of directors, and it's the first of its kind in Canada. And
what's the advantage there?
Well, it's about true reconciliation and working with your partners. They have a seat at the table, a voice at the table. You know, many of the other deals that have been done in Canada have been, you know, minority interests where it's essentially a financing and there's not really a say in the day-to-day and governance of the asset. And so this project is in their traditional territory, and they have a voice on how it's constructed and how it moves forward. And so we're really excited to have them as a partner. We FID'd that in 2024. This year, in 2025 mid-year, we started steel cutting, which essentially means the start of the floating LNG vessel. We actually had remarkable weather in Kitimat. For anyone who's been up there, it rains like 250 days of the year, and we didn't have any rain this summer. So we almost constructed the entire pipeline, you know, this summer, which we thought was going to take over 2 years. So
Kitimat is about 200 miles northwest of Vancouver, so it's pretty far up there.
Yeah, good point. And so as of right now, construction's going very well. We expect to float the vessel over in early 2028 and hook it up. And you know, it'll be about 400 to 450 million cubic feet a day, which doesn't sound a lot, but that's 2 to 3% of gas production today in Western Canada. And when prices in Western Canada are, you know, over the last 3 weeks have been anywhere from negative 50 cents to positive 25 cents per MCF, compared to 350 NYMEX in the US, we need every project that's possible to consume natural gas or get it out of Western Canada.
Let's dwell on that for just a second. So when you said prices go negative, that means that prices go so low that they literally fall below zero, and producers need to pay customers to take the gas away, which is obviously not what producers want to have happen. Can one of you just explain briefly kind of how that dynamic happened over the last couple weeks?
Sure. I think what we saw is some egress outages on a couple of pipelines and a temporary shutdown on LNG Canada. I think what happened is supply had grown with the LNG Canada coming online. And when you see these hiccups in the energy infrastructure, you see that there's no place to move the natural gas, as it's almost like a real-time production process. And then with those situations, you'll see prices drop dramatically because there's a limited amount of natural gas storage to put that product away.
And so it really is evidence for a lot of the things that we're talking about here in terms of the need for more infrastructure.
Absolutely.
Vern, while we have you here, can you tell us a little bit about your propane export projects on Ridley Island?
Sure. So Canada is also a major exporter of propane, which is a natural gas liquid. And Canada produces about 500,000 barrels a day of propane. About half of that gets used in the country. And the balance gets exported to either the United States or Asia. The U.S. is obviously long propane, with one of being the biggest producer of propane in the world. And it already exports its propane to Asia and other countries. So Canadian propane is the cheapest propane in the world, highly discounted. And by being able to export to Asia, we can get the best pricing for our customers. And in fact, by moving that product to Asia, we can, on average, increase the netback on a barrel of propane by about $10 a barrel for our customers. So we're in the process of building our third propane export facility on Ridley. This one's on Ridley Island. It will be a very significant facility where the initial phase is 55,000 barrels a day of exports. We're very close to FIDing an optimization of that expansion already. And then ultimately, the project is being built where we have wharf capacity and rail capacity to do 10 times what we're doing in phase one. So effectively, as NGLs grow in Western Canada over time, we'll have sufficient capacity to export all of that to Asia.
And Eileen, can you tell us, Keyera just in the last month or so announced a very significant acquisition to buy Plains Canadian natural gas liquids business for about $5 billion. Can you tell us a little bit about how that really changes the game for your company and how it fits into all the things that we're talking about here today?
Yeah, absolutely. We were really excited to announce that acquisition. Let me take it back to our strategy. Our strategy has been to enhance, extend our value chain. So our value chain, when I refer to that, it's really the infrastructure and services to move product from wellhead right to end market. And this acquisition, there's really no other acquisition that fits our strategy better. When we bring the two platforms together, we get greater efficiencies, significant cost synergies, and ultimately, and broader market access. So we're able to access markets across the country, but also into the U.S. And it really does bolster our propane value chain. And really that fits into, we've partnered with AltaGas as well to move propane so we can provide that to our customers. It can go to the east, or it can go to the west through AltaGas's facility. So ultimately what this all means is it's great for the customer because it means we can provide a more cost-effective midstream all-in solution for the customer. I think the other really important thing to note is that we are now bringing these assets that were owned by Plains All America back under Canadian ownership. And so our goal is the cash flow that's generated within that company, we want to retain and reinvest within Canada in more infrastructure, which again creates more jobs and more opportunities.
Got it. And Scott, you told us a little bit about your LNG project, kind of the other side of that demand, the domestic demand revolves around data centers. Can you tell us about your plans for a power plant near Edmonton?
Yeah, thanks. We put out a press release yesterday morning just updating the market in terms of what we're doing in Western Canada for an innovation center right outside our Redwater facility. And so the goal of that project, it's a 50-50 joint venture with our partner Kineticor, is to build up to a 1.8 gigawatt power plant, behind the fence power plant, really to power large innovation centers in Alberta. And so
1.8 gigawatts is enormous. It's like the size of 2 nuclear reactors.
Yeah, it's billions of dollars of investment, and what we also like about it is that it consumes natural gas, and that's also a key component of that project. You know, Pembina is not in the merchant power business, and that's not what this is. This power plant will only go forward, you know, if we strike a deal with our innovation center partner, and the goal there is to build 1.8 gigawatts, but also tie that to an Alliance expansion, which is a pipeline that we own today. We'd like to do a short-haul expansion of that pipeline, feed natural gas to the power plant, which will then power the innovation centers in Alberta. And again, that would consume somewhere in the neighborhood of 300 to 400 million cubic feet a day, which is, you know, again, a 1.5 to 2.5% demand for natural gas. And just anything we can do to help the demand side of natural gas will help, just given the pricing dynamics. So we're really focused on what are the projects that can add value to that gas molecule. So that project, we press released some of the milestones, a land sale, and the advancement of that project. We ordered our turbines in order to secure our spot, with an overall FID expected in the first half of 2026.
Got it. Well, we would love to have all three of you back in a couple of years and hear more about these projects and how they progress and how things unfold under the new administration. But in the meantime, thank you for joining us today. And thank you, all of you, for listening. And that's it.
Please welcome to the stage John DeBert, Executive Vice President and Chief Financial Officer of Air Canada, for a conversation with Bloomberg's Mathieu Dion.
Good morning, John. Just a word about you. You spent nearly your entire career in the aerospace industry. You've worked at Pratt & Whitney. You were the CFO of Bombardier between 2015 and 2020. That was quite an interesting period. I would have a lot of questions about that.
Yeah.
But we're here to talk about Air Canada, where you've been CFO since 2023. 5 years after the pandemic, how would you describe the state of the airline industry today, and what are the key consumer trends you're seeing right now with the post-COVID era?
Yeah, good morning, everybody. And Mathieu, nice to be here with you today to talk about Air Canada. I think that, 5 years later, it's starting to be far in the rearview mirror, the pandemic. And I would say that the industry has taken some time to recover. Today, people love to travel, and they've traded, I'd say they traded travel up their discretionary spending. A lot more attraction to premium travel as well. So that's folks that want to go through lounges or inside the cabin upgrade as well. And the other thing that we're seeing that is kind of happening over the last couple of years, and it's a trend that's starting to be a little bit more pronounced, is particularly North American travelers extending their travel season outside of the peak summer period. So we're seeing travelers going to Europe, where they would typically go in August or July, into September, October, and even early parts of November. So by and large, I would say that the industry is starting to really gain traction. There's been some challenges over the early parts of the recovery with the availability of aircraft, and some cost pressures as well with the inflation that everybody has kind of experienced. But travel and people's habits with travel continue to be, I'd say, higher priority.
During your Investor Day, I think it was last year, you showed out the layout of an aircraft. The aircraft pretty much of the future at Air Canada. So if I'm going into an airplane, let's say in 10 years, what's the layout look like? What key differences are we seeing there?
Well, I would say that, cabins typically are being upgraded. They used to be every, 10 to 12 years. Now we're seeing 7 to 10 year cycles. The entertainment systems, mood lighting, we work on making the experience as well, airframers with cabin pressure and how the aircraft and how you feel once you leave the aircraft. With respect to premium cabin, there is going to be a trend towards more premium economy and as well as business class seating. I think for Air Canada, we have a very balanced cabin interior, and so we actually cater to multiple types of customers in any given aircraft. I think range for Air Canada is also something you'll be looking for, not so much inside the cabin, but even extending our ability to point-to-point destinations.
But at the end of the cabin, like my understanding is that like you will have less space. It's going to be more affordable for certain people in the middle.
Correct.
Maybe a little bit more expensive. You have more room legs.
Correct.
So that's going to change, right?
No, I'd say that the future is going to be having a product for all customers, and obviously we'll segregate the cabin appropriately. So if you want to have the best travel experience, you'll be flying in the front of the cabin. But our premium economy seating is fantastic. In-flight services as well, entertainment systems. I think those will be great experiences. And there will be also basic fares for those that need more value proposition. And I think that for Air Canada, that's our market. It's a very balanced market.
Great. You've kind of touched it, but what are the most pressing challenges right now? You've had a flight attendant situation, a strike this year. Are labor costs a big issue for you right now?
Well, I'd say that we were eyes wide open. In December of 2024, we laid out an investor day, a plan for the airline for 2030, and in doing so, we talked about the impact of lagging inflation. So the world has gone through some significant inflation in 21, 22, into the early parts of 23. We had long-term agreements, 10-year deals with a lot of our labor force. Those were 2015, expiring 24, 25, and we're working through them. So I think that we're very realistic about the cost and the inflationary pressures. We have three areas that are probably the most pronounced challenges. Number one, the step change towards labor, which we're going through, and I think we've understood well the implications of that in our cost structure. Two is in Canada, significant important investments need to be made in airports, and there are billions and billions of dollars, probably upward of $20 billion in the major hubs in Canada investments. That will come back to our cost structure, but it is a benefit, and we are a global carrier. We depend on our global hubs in Canada to connect passengers around the world, and so those investments are well appreciated. They will have a cost implication, and then the maintenance cycle of aircraft and the pressure on that. Now, I'll be brief on. We also have a very clear margin expansion plan. In that same investor day, we talked about 15% margins going to about 18% from an EBITDA point of view. And in very simple terms, we are in an expansionary cycle. We're growing. We produced about 105 billion ASMs this year, roughly. We'll grow to about 130 billion ASMs in terms of overall capacity by 2028, 2030. And in doing so, an airline does absorb costs better. Two, there is significant opportunity for productivity in the overall workforce as we continue to introduce tools, technology. We have about $1.5 billion of technology spend over the next 3 to 5 years. And finally, we're going to be bringing in almost 90 new aircraft, a variety of different aircraft. And those aircraft are the best in class modern aircraft. They will bring 15 to 20% cost reduction from operations, fuel burn, as well as maintenance, and just overall operating costs. And with all of that, that does actually bring margin expansion even in a tougher cost environment.
The airline industry, it's a cyclical industry. Where are you in the cycle right now, and how do you navigate through the cycles?
Yeah, that's a great question. I think that, and a lot of credit goes to my predecessor and the team that was there as we entered the pandemic, right? We had a one-time leverage balance sheet. So one of the ways that you manage this business well is you keep a strong balance sheet and you allow for flexibility when recovery comes. And we have been in a, I call it a latent recovery, but we are now in the full cycle of bringing on new aircraft. We retired, I think, almost 80 aircraft during the pandemic, wide bodies and narrow bodies alike. And so we are modernizing our fleet over the next 5 years. We've taken, the entire impact of the pandemic and come back in 2024 back to about one-time leverage. So one-time leverage, a clear structural growth plan that is really levered around Canadian travel and international, the international network that we serve, and we can talk more about that, and investments in aircraft, and yet keeping a balance sheet of about 2 turns or less of leverage. So strong balance sheet, agile, redeploy aircraft where we have moving factories in the end, right? So when it's not working in one part of the world, we can move that factory to another part of the world. And we do so, I'd say, better than most. And we've shown that even with this latest transborder challenge that was on us in 2025, repositioning aircraft and being agile. So I think strength comes in agility and a strong balance sheet.
WestJet made a firm order of 67 aircraft in the past few weeks. Does that change anything for you in terms of planning, just to keep yourself competitive?
Yeah. Again, we always assume and model competitive forces when we develop our long-term strategy. We have a very clear strategy to grow to about 30 billion in revenue. We're about 22.5 billion now. We feel confident that the strategy we picked really relies on factors that are included in a competitive landscape, such as WestJet. With respect to our own fleet plans, we are bringing value to leisure travelers. In a sense, that's where their narrow bodies probably will go. And we ourselves have a plan to have an all 737 very efficient fleet for leisure travel. So our Rouge brand is going through a transition into an all Boeing fleet from a variety of aircraft. That'll give us standardization. But I think, it's a competitive world, and airlines have always been competitive. I think our structural growth plan does stand on its own.
What are the growth opportunities, or the biggest one you're seeing right now that's not already there for you? Or?
Yeah, I think that to be very clear, right? So in terms, just so that kind of gives you a bit of an anchor here, we were at about 113 billion ASMs, available seat miles, in 2019. We completed 2024 at about 104 billion ASMs. We had an old fleet, we retired older aircraft in our fleet. That was part of the reduction of capacity. We're going to go from that 104 to about 130 billion. That's about 4 to 5% capacity, passenger traffic growth over the next 5 years. And the way we're going to do it is really structural. Number one, GDP has grown and will continue to grow, even if it's modest, 1.5%, 2% a year. So we're not expecting, or we're not planning on excessive GDP growth. Two, the Canadian demographic has changed dramatically in the last 15 years. And Canada is now over 40 million people. A lot of immigration coming from Southeast Asia, from India, from North Africa, the Middle East, perfectly suited to our international network. So we're growing into those markets. Those markets are growing 8, 10, 12% per year, year over year, within our franchise. So they grow at 2 to 3 times GDP alone. And then the third important element is that we have a gift in Canada. We have a geographic gift. We are the shortest route from Vancouver, trans-Pacific. We're also the shortest route transatlantic from Montreal. And we have a global hub in Toronto. That connecting capability allows us to bring what we call Sixth Freedom traffic. So either American travelers going through one of our hubs into Europe, in the fastest connections in many cases, Europeans going into the Caribbean, for example, flowing the other way. So that growth itself also offers Air Canada an expansion of its international capabilities. And we're building the fleet to do those things.
You talked about the GDP, about the economy. What are the direct or indirect impacts stemming from the U.S. tariffs on Air Canada?
Well, I think like everybody else, we're working through it in lifetime. So that's, when you look at a direct impact in the spring of this year, there has been a reduction of transborder travel, specifically point to point, probably in the low to mid-teens. That's been fairly stable. I think we're past the variability of that now.
The leisure travel mainly, right?
Yes, the leisure travel. What we're seeing, to be honest, right now is increases in corporate travel, including U.S. transborder. And I think that Canada itself should and can leverage Air Canada and its ability to connect it globally. We fly to over 200 destinations around the world. We have an incredible global network. And I think, we can be and will be a catalyst in helping the Canadian economy expand and diversify, but also to keep that connection to the U.S. and continue to be the largest transborder airline in the world anywhere, obviously US, Canada. So I think we play a role. We're going to invest probably $20 billion between 2024 and 2028 in the airline. And some of that is obviously half of that is in aircraft. I think we can be a catalyst for the Canadian economy and for Canadian trade.
Great. Just want to quickly touch on the flight attendant situation. So it's in arbitration right now.
Correct.
Your latest offer was a 40% increase in overall compensation.
Yes.
There was a $375 million loss there because of the strike. So what's the impact on your financials down the line because of this situation?
Yeah, great question. So one, we issued a press release, must be now a week or two ago, really just clarifying the entire impact of the work stoppage. That was roughly close to 5 days of operations that were shut down. $375 million, that's the implication of it for 2025. As you said, most of the agreement is now confirmed and locked. There is an arbitration process for wages. We expect that to go through the proper process over the next couple of months. As we look longer term, I think we've been realistic about our assumptions for these cost adjustments. And so whether it be pilots last year, we renegotiated successfully a 10-year deal expiry. We will get through this with the flight attendants. We have mechanics coming next year. Across the board, I think we have been realistic about the expectations of adjusting costs for wages. And we are focused on productivity, improving the airline overall, and offsetting some of that cost pressure. And then when you have a modern fleet, larger aircraft, larger airline, there is a scale and productivity benefit that will help us absorb all of that. And technology will bring productivity as well.
All right. John Diebert, thank you so much.
Thank you. Merci, Mathieu. Thank you.
Please welcome to the stage Brian Kaner, President and CEO of Boyd Group Services, Inc., Murray Mullen, Chair, Senior Executive Officer and President of Mullen Group, and A.J. Vermani, Founder and Executive Chairman of Cargojet, for a conversation with Bloomberg's Monique Malima.
Well, thank you all so much for joining us here today. So maybe just to start, if you can each give just a little bit about what your companies do in both Canada and the U.S.
Starting with me?
Yes.
All right, perfect. Well, good morning, everyone. So the Boyd Group Services actually participates in the $50 billion North American collision business. We've got about 1,000 locations now across the United States and Canada. Been in business since the early 90s with the Boyd Group, and actually the Gerber brand, which is how we trade in the U.S., has been in business since 1938.
So Murray Mullen, good morning. The Mullen Group, we were actually a private company back until 1993, then we went public, and since then we've acquired a number of other private companies in both Canada and the United States. So today we operate a pretty large logistics and trucking company. We have operating in 4 segments, distinct segments of the logistics space, which is massive. Everybody knows, everybody talks about logistics. And our largest segment right now is our less than truckload side. And that's all in Canada, less than truckload. Our logistics and warehousing side, which is involving logistics, handling a lot of longer haul freight. And then we have our US 3PL, which is involved in both customs and US 3PL, dealing with international freight, and it's based out of Chicago. And then we have our specialized division, which really was one of our largest segments until there was a decline in the energy space in Canada. And then we pivoted away from that and went more into the consumer side of the economy. So that's our business today. We're doing over $2 billion and have 8,500 employees, both Canada and the United States.
AJ?
Yeah, good morning. AJ Vermani. I'm Executive Chairman of Cargojet Airways. Cargojet in Canada started right after 9/11. We started with a couple of planes, 727s, flying cargo. we felt there was a need. Me coming from the freight forwarding business, we were always buying space from some cargo airlines, 1-2 plane operators all the time. And the vision was basically to have an airline, because of the size of the land Canada has, the different time zones and consistency of services was never there. Part of the reason was that all cargo airlines in Canada prior to that were part of a passenger operation, and the focus was never there. So we started an operation in Canada right after 9/11, simply because I think the challenges created certain opportunities, and we set up a cargo airline. Today we service all Canadian cities, 16 cities, every morning, 5 o'clock, scheduled network, 7 days a week. Our other segment is ECMI, where we we call it wet lease as well, where we fly 20 aircraft from various integrators throughout the world. So a total fleet of about 45 aircraft, 767-300, 757s, and we service a lot of global strategic cities, carrying about 25 million pounds of cargo. Especially during COVID, the growth we saw with the e-commerce has continued on. People's trends have changed. They're buying more on e-commerce than going to the stores. And I think, we call ourselves Canada's pipeline in the sky pretty well. It's like you need your utility and water and electricity in the morning, you need your parcels, and that's where Cargojet comes in.
Yeah. So we're here to talk today about how Canadian companies are navigating North America. And one of the big topics, obviously, this year, and that we've also talked about today, has been tariffs. So Brian, I want to start with you. For Boyd Group, you've said that they haven't really seen a lot of impacts from those tariffs. Can you talk a little bit about why that is and how you've been able to build up that supply chain resiliency?
Yeah, well, we really sell two main components. I mean, we sell labor, which is obviously tariff resistant. And then the other piece is parts. And the parts piece of our business is usually what's affected by the tariff environment. And as we think about our business, our parts sales are actually just a pass-through. So it actually has a very minimal impact on our business. And if anything, it has a slight positive impact to the bottom line as parts pricing go up. That said, when you think about the overall impact of tariffs and the impact it's having on parts prices, which we do now start to see we are now starting to see go up. About 44% of our parts business actually comes from parts that could be part of the USMCA agreement. And as we think about that, we've got to be very careful to make sure that we're using parts, one, that aren't affected by the tariffs. Two, it puts us in a position where we actually are diversifying the parts that we use. We have the ability to use what's called OEM parts, which are parts that come directly from the manufacturer of the vehicle, or we've got aftermarket parts usage. The aftermarkets piece of our business tends to be more susceptible to tariffs because it comes from countries that are more tariff oriented. Versus the OE side of the business, which actually tends to be, as I said, about 44% of those parts come from non-U.S. companies or non-U.S. industries. And those could be subject to tariffs if they don't fall into that USMCA. So we're very focused on keeping a diversified supply base and continuing to just drive value for our insurance clients.
Mm-hmm. And one of the other topics with all of this tariffs is there's been a lot of uncertainty. But even amidst this, Murray Mullen Group has continued to expand with acquisitions across North America. How do you do that intentionally and successfully in a time when there is some of this investor hesitation?
It's challenging. It's not as easy with the rules changing the way they are. But notwithstanding that, you still got to have a longer term vision, and you got to invest where you think that there's going to be a future. So one of the things that we did is we've been de-emphasizing the trade between Canada and the United States for some time, because in the transportation business, it's not good enough to get one load, you have to match. And with the tariffs coming in. I don't know which side of the trade gets messed up, but it only takes one to mess up two. So we've de-emphasized that. And by the way, we've seen quite a disruption of cross-border traffic. It's not as strong as it once was. What we did is we pivoted and we invested in a customs brokerage business for the very reason that Ron's talking about, is that trade is going to be more complex. It's a transaction. So we've invested in one of the largest customs brokerage companies in Canada. We just closed that deal in June. We've been working on it for a while before the trade issues became what as problematic as they become. But all of that said, our view is that all governments will want to know more about what's being imported or exported out of their countries. I don't see that going away, so we invested heavily in that. And that's part of logistics, is helping your customer navigate what's the customs rules. How do you do the transaction with the government? Can we help you out? That's all part of logistics. It's not just we just have trucks. So that's why we're a logistics company, not just a trucking company.
And for you, AJ, as there's been trade pressures, like we've mentioned, not just with Canada and the US, but also with the US and Europe, Cargojet's been able to grow its domestic business. So how do you play to those strengths in Canada when there is that kind of uncertainty in other parts of the world at the time?
Well, Canada is a very unique country. It's the land mass is amazing. Like, it's got 3 different time zones. Cities have, from Newfoundland right up to Victoria. And I think the key for us has been, with all this uncertain stuff, as far as domestic is concerned, people's habits are e-commerce. They're still buying. They might not buy a $100 pair of shoe, but they're buying a $50 pair of shoe. So the shipping hasn't stopped. So that's what the domestic momentum has continued, because people just don't want to go to the stores to look for little things. They might not be buying as many as goods, but they're still buying. As more e-commerce has increased, the technology certainly helped in that direction. On the international scale, the de minimis being eliminated for $800 had some impact on our flying for certain global integrators. But overall, whereas Europe might have slowed down, but Mexico has increased. So there's always opportunities that are there in our field. But I think the key thing for survival during these uncertain times is, number one, we got to keep our service up. We continue to deliver at 99.5% on time, because when people want air shipment, they don't want to hear it's 2 days, 3 days. They come to work at 9 o'clock in the morning, so they get their parcels. So service has been very, very critical. Customer obsession, which is one of our key ingredients of success. And secondly, in these uncertain times, when your name is airlines or airways, people think it's licensed to spend money. CapEx is so high, people go crazy on spending all kinds of money, no sort of discipline in that direction. So Cargojet maintains a very cost discipline, and especially through these rough times, to make sure that we got to be cost conscious and service conscious. Those are the key elements that we practice, and that's what being a key to survival in these times.
Mm-hmm. And for you, Brian, how do you kind of see the resiliency of your customer, and how do you kind of react to that? I know Boyd has been focusing on internalization and some other efforts to kind of build up the strengths within the company. How are you doing more of that?
Yeah, well, I would say the collision space has been remarkably resilient for a lot of years. There have been some things recently that have come into play that, that have shook the industry a bit. Having looked at, having seen insurance premiums skyrocket last year as the cost of repairs have gone up, we've seen, challenges as it related to that. I would say that, in my view, the one thing about, the most, your ability to be resilient kind of hinges on your adaptability. And we've really focused in on One, deepening our relationship with our customers and making sure that we understand how to win with our customers. Two, developing or maintaining, the great relationships that we have. And then three, investing in our technology and our technicians. So technicians for us, as you think about one of the things that disrupted the space in 2023 coming out of COVID was the lack of available workforce. Many people got out of the space and didn't come back into the space. And one of the things that we were able to do at that time is leverage our technician development program and really turn that up in a way that allows us to graduate. We've graduated 500 people from that program today. I think it's one of the best programs in the industry. And it does demonstrate that when something happens to the business, you just have to adapt to that and have to be able to pivot. And our ability to pivot quickly in that environment is what's given us the ability over a long stretch of time to be successful.
Thanks. And for you, Murray, there's been kind of impacts in terms of capital investment in Canada, but there's still a lot of strengths that we're seeing within a lot of these industries, especially like we've been talking about earlier about the energy space and some of the hopes that people have for that. What do you see kind of the outlook being for that right now and for your company?
Okay, so we have a good portion of our business that's tied to the energy sector, and I listen intently to what politicians say and what our customers are saying. There's a lot more constructive talk, but I come from the cloth that says we need a lot more action, a lot less talk if we want to get. So I will wait patiently till I see the action before I deploy our capital into that space. It sounds good, but Canada's got some unique issues that you have to address if you're going to build a pipeline across provinces. You heard that on one of the previous panel discussions. So once that pipeline gets built, that's the go time to produce it and extract it, and that would be a huge investment thesis for us. Until then, I just got to be a little bit careful with our shareholder money, and we're focused on other parts of the economy. We think that's why we're in LTL, because we think freight will always move, consumers will always consume. And what we're focused on is how do we just do it smarter and better. And clearly that's, lends itself to the technology. You've got to invest in new tools all the time. I would say to you, it's one of the things, even though we're a diversified company, one of the common themes that we have is we must always invest in technology so we're best in class to keep our costs down. It's the only tool that I know how to keep costs down. We also use a number of third parties, independents, because to be honest with you, we can't be all company employee. Those companies are really under stress today in a really competitive market. So we have a balanced approach on how we move the product.
Mm-hmm. And for you, AJ, Cargojet has a lot of partnerships with multinational companies like DHL, like Amazon. How do you build up those partnerships and also keep them strong at a time when they're also dealing with their own different uncertainties and impacts of trade and tariffs?
Yeah, and the key to all these partnerships, it begins with value for money. Service is critical. All of our customers are in the same business, like if it's UPS, it's DHL, even Amazon for that matter. They all want one thing, is service. And first you provide the service, and if we as a company can keep our costs down, then we can provide that value for money type of proposition. But I think key to these partnerships is giving these companies the flexibility they need, because they're in the same business. They need to scale up, they need to scale down. We understand. They need to change their routing. The flight is not going to Mexico today because they want to consolidate it for 2 days, but there's an opportunity to change the routing to Europe, maybe going to Germany. So I think the flexibility that we will provide to scale up and down, to increase the flights during Christmas time and peak times and Amazon Prime days and having enough backup capability for these people, that is very, very critical. And I think that the partnerships we have developed, where we have done some warrant deals with Amazon and DHL, and I think all these deals for the customers, it's a value-added, accretive deals because they're getting their cargo services, they're investing in Cargojet, they're building, and they share a little bit of rewards in the end. So it's partnerships words are taken very lightly these days, but for us it means a lot. And I think to bring them into the partnership, you got to make them feel part of it. And by providing them the service, value-added propositions, and again, giving them something, rewarding them a little bit by being part of our success.
Mm-hmm. And some of you have touched on it a bit, but I'd like to talk more about technology and the ways that you can leverage technology to strengthen your supply chain. So maybe, Brian, if you could start about what are some of the things that Boyd Group is doing with technology right now?
Yeah, well, obviously with 14,000 employees, it's imperative that we continue to use technology to drive efficiency through that workforce. We launched a plan called Project 360, which was a $100 million cost transformation plan in our business. As part of launching our 5-year strategy, the 5-year strategy was really to double the size of the EBITDA in the business, drive us to a $5 billion business, and get to 1,400 locations. As I said earlier, we sit at 1,000 today. We've got clear line of sight into the ability to get to that, that growth plan. But the piece of Project 360 that's really hinged to technology is about $30 million of savings on the backside, of the 5-year plan that really is hinged a lot on AI. Our ability to leverage AI to drive. We write estimates when a vehicle comes in. Think about an environment where we can take a picture of a vehicle and AI can actually write the estimate because they've seen that accident, they've seen that damage, they've seen all of those things, and the ability to just de-skill that or to take, pieces of that work and turn it into, some machine learned processes for us. It really is the front office is really where we see the biggest benefits of technology. When you think about the back office or back part of our business or the direct labor piece of our business, our technicians, the best thing we can do for them is give them the technology at their fingertips to be able to stay in their stalls. When they stay in their body stalls and they're working all day long, they're producing hours. When they're producing hours, that's obviously allowing us to be more productive in the stores. So we've got efforts on the front side and the back side of our business to really use technology to just drive efficiency through both sides of the operations.
Mm-hmm. And what about for you, Murray? How is Mullen Group looking at kind of the evolution of technology and how you can incorporate it into your supply chain?
It's the one part of our business that we've not cut back on spending or investing, which is technology. So we're a very diverse group, so we don't have just one technology platform that can go across for all our businesses. What I would say is this, the common theme is we invest in technology. So where we need, in our warehouses, we have more robotics than we've ever had before. Most of our warehouses will be all robotics by the end of this decade. I'm pretty sure of that. On the truck side, on the operating asset, that's not us. We are putting tremendous pressure on the OEMs to say, you've got to give us a better product so I can lower my overall cost. And the biggest cost that I can get lowered is if we can increase fuel mileage. And so we put a lot of pressure on them. I've delayed buying trucks right now because, to be honest with you, they haven't brought the cost improvements to us that will help on that side. So we've been putting pressure on them on that side. It's on the labor side that we need to use AI much more efficiently, which is just data. How do we access data? How we give it to the right person at the right time so they can make the best decision at that time. And we're working with our IT groups and providers as to how you integrate them. They're the ones that are going to have to integrate it in. So we don't just give you data, we give you information that helps you do your job more efficiently. And that's where I think that's going to be the power of AI. I think that's a big buzzword, but at the end of the day, it's just better information delivered on time with what somebody needs right now to help them do a job more efficiently. Mm-hmm. So we'll have to do that.
Yeah. And for you, AJ, how is Cargojet leveraging?
Well, Cargojet needs, definitely we need to work towards getting more AI in areas like maintenance, for example. You take a picture of where the leak is. Let's say there's an oil leak, and the AI can tell you exactly what parts and where you can, just like your business, Brian,
Mm-hmm.
So we're going to move towards that direction. We're looking at it. Flight operations, for example, where the pilots are flying, what routes they should take, what's the optimum weather conditions, the fuel burn, uplift of cargo, how we can maximize the payload on the aircraft. One thing we obviously can't get rid of, like no matter how much AI you put in, you can have more data and you can do a little more planning, but somebody has to physically load the planes. And that sort of is, I don't see that how AI can come and load the planes and plan the, yes, they can do the planning, they can make more efficient, but I think that, making the airline side more efficient with AI is our goal, and that's what we're moving towards.
Mm-hmm. Well, thank you all so much for being here today and talking more about how companies can navigate across Canada and the U.S. Thank you all.
Thank you.
Thank you.
Please welcome to the stage Oskar Lunowski, founder and CEO of Orion Resource Partners, for a conversation with Bloomberg's Joe Doe.
Oskar, thanks for joining us today. Hopefully we can give a bit of a lively update to this crowd of the wonderful world of critical minerals, which maybe 10 years ago, if you and I were sitting here, you would have said, why are you asking me all these questions about scandium? But I do think it's an interesting one. So maybe we start there. You've been in the commodity space, in particular mining, for quite a long time. How has the critical minerals investment space changed over that time?
I guess the main thing to start out with is that a lot of these critical minerals are not really big volume products. They were for years called minor metals, because they were exactly that. But the world has moved their definition from minor to critical, which is, helpful for people in the space like myself. I've always thought they were critical, but who am I to say? But as the economies have changed and as the concentration of the processing of those minerals has become that ownership of one country, China particularly, things that were considered afterthoughts are now central to the thinking of both the governments in the West and the Chinese government and industrial customers that have found themselves ever since the Japanese first suffered embargoes, found themselves in short supply of some of these metals. And as the renewables industry and EV industries have become larger, the magnets that these use have critical materials in them, and you can disrupt an entire supply chain by just disallowing the availability of one critical material, and that's hence the criticality of those. So you've heard me say critical like 4 times now in one sentence, so it's clearly important. And here we are. We're in a world where a lot of critical materials is first described by Trump 45 for military criticality, then expanded on by Biden to include a lot of renewables-based criticality. And now under Trump 2.0 or Trump 47, the list has gotten even larger and has now both got a renewables component to it and a military defense component associated with it.
One of the issues for years is getting investor interest in these things. And a couple of years ago, we wrote a story at Bloomberg talking to former DoD officials who had talked about the difficulty of getting administrations, not just one, but multiple over the course of the past, call it 15 years, to actually understand the trouble that the U.S. was facing in terms of if China suddenly put export controls on, say, permanent magnets or germanium and gallium, that there would be a problem. It seems like we are at that point where that has now become not just a narrow focus of folks within the DoD, but mainstream.
DOW now.
The DOW, excuse me, Department of War.
Pay attention.
But those same DOD officials, always said it can't just be the Pentagon that is the sole consumer. You need a vibrant private market.
That's right. The military use, while critical for the military, represents less than 10% of the usage of the U.S. economy for those same metals. So for every Virginia-class submarine that needs 5,000 tons of this material, there is an entire EV market, entire wind turbine business that needs multiples of those amounts. So it's a tail wagging the dog situation when you focus on the DOW's requirements. The entire U.S. economy, to greater or lesser extent, for all sorts of things, including computing power, including quantum computing, including AI, the energy generation for AI, all need critical materials. And so while you want to and could solve maybe the defense problem fairly simply because the quantities are so low, that doesn't help the U.S. economy overall. And the U.S. economy requires increasing amount of this material. The idea is that sometime by 2027, 28, the amount of demand for the U.S. economy for these critical materials is expected to double. So we're not just behind, we're also going to be increasingly behind if we don't do something about it.
Which kind of leads us to the question of we have the government starting to get involved, actively involved. They took a stake in Intel, the chip producer. They have taken stakes in MP Materials, the lone U.S. rare earth producer. We had an announcement yesterday that Trilogy Metals, which, if you've heard of Trilogy Metals, congratulations, you're probably one of 10 people who have heard of this, was just basically told to build a road that had not been allowed to allow for infrastructure to start building out copper, cobalt, and whatnot. Is there incentive for investors to start to become part of these public-private partnerships?
Absolutely. I believe that what you're seeing with copper prices, what you're seeing with even with gold prices these days, and silver prices, is an indication that at least the world is starting to appreciate hard rocks and the minor metals and critical materials that are embedded in there. They realize that the opportunity for returns is there and sufficient. The question will be that the rocks are where they are, right? They've been there for 350 million years or so. They're not moving. And if that country is not the United States, it's an emerging market country, it's Africa or some parts of South America, there's a geopolitical calculus that has to be considered as well as the just pure mathematical returns that are available. And that's where the partnership between a private sector and the government becomes really important. I think you need both people, or both government and private partners working together to make the particularly emerging markets system flow. You don't just need dollars from the government, you need their sort of support and protection in a way to make sure that the private partnership, which really brings to the table the expertise in the mining and the processing of the material and how to make sure that the project actually sticks together and is profitable. You need both those things to work in emerging markets because of the geopolitical risk, and in the United States and other sort of first world countries because the permitting situation is so complicated. You just gave a perfect example with Trilogy, right? This was a permitting blockade that took about 8 years or so that it was in permitting. And with one stroke of the pen, the U.S. government said, enough of that, let's fix it. And so it's fixed. You'll see that happening more and more often. So it's not just dollars from the government, it's also permitting in certain places and geopolitical support in others that bring that sort of fruition, that possibility of something that was complicated into reality. And as I said, the private side is there to sort of act as the subject matter expert, really.
So you, with the perch of Orion, would be interested in these public-private partnership type deals?
I think on a case-by-case basis, absolutely. Orion's been in this business now for 12 years. We've financed and built mines in 29 different countries. So we have a fair degree of expertise in what works where. And there are certainly certain countries where working with a government would be super helpful. And not just money, but also just the fact that you can call on somebody in Washington or in Toronto or I guess in Ottawa really to get help that you need to keep things going. And everybody wins in that scenario. The governments and the industries domestically get raw material supply that they need. The emerging market or other country gets jobs, gets tax revenue. And if done properly, which Orion always seeks to do, it can be environmentally beneficial in the long term because you're displacing fossil fuel, which just needs to be burnt and reburnt with something that's a one-off environmental charge and then recyclable in most cases. So,
Bloomberg News last month reported that Orion was in talks with the government to create a $5 billion fund that would be able to deploy money in the critical minerals space. Is that something you can confirm to us here?
I wish I could, but I'm not going to. So, no, we're definitely in discussions with the U.S. government and other governments about building a partnership to do exactly what we just said. And conversations are progressing and we're marching forward. With governments, you get to move at the speed of bureaucracy, not at the speed of business. So it's always a little bit more challenging. But I think the goodwill is there to make something happen.
How do you think these public-private partnerships should be shaped?
I think as long as everybody in the partnership acknowledges this expertise of what somebody brings to the partnership, that's helpful. And I also think, and it is probably the most important, as long as the capital contributions come from both sides, so that the government has the assurity that the private sector has got skin in the game, that's important. And as long as the private sector appreciates that the government is representing taxpayer dollars, so that there's something associated with that requirement for the government to look after those dollars, and in that case, they're actually helping you to navigate issues on the ground. The partnership should work. The less political it is, the better, I think, as well. So we'll see how it goes, but I have faith in it working.
And I guess to help the point there, when you say less political, you mean if you're dealing with different agencies within the government, right? Because there's the kind of government agencies that can deploy money, so to speak, would be the DOW, the DOE, the Department of Commerce. They've all done so thus far. And you're saying it is useful for investors to be able to have the conversations with kind of the career experts within those agencies, not necessarily having to depend on political appointees from administration to administration?
I think political appointees are crucial.
Okay.
And I think they're crucial because they set the overall strategy and direction and sort of end goals. But I think it's also important to make sure that the staff level folks are armed with the necessary tools to move things along. Because if not, things will get stuck in the machinery. Orion has, 85 people that do nothing but mining. So we have our own in-house technical team, and we have our global sort of office network and sourcing network. So we can move at a pace, because for us this is bread and butter. But the staffing folks at the U.S. government and other governments, they need to be sort of empowered, as it were, to do transactions.
We're speaking at a Canadian conference, if you will, here in New York.
Yay.
The question is, for these investments, should it be domestic only, onshore only, or should we do to use the terminology from the Biden administration, friendshoring, where you include your closest allies, Canada, Australia, and others?
Yeah, look, I think Canada is kind of a core to this whole thing. As much as the U.S. as a capital market has expertise in oil and gas, I mean, the U.S. is an energy-dominant sort of economy and capital market. Canada has that same analogy, along with Australia, of being sort of the center of the minerals and metals sort of ecosystem. I think 2/3 of all listed mining companies are listed in Canada. And so there's a lot of resident expertise in Canada, both in the Canadian government, on the federal level, and in the different provinces, that sort of is sort of helpful to and crucial to developing projects, both in Canada but also just in North America writ large. So Canada has a massive role to play here, in fact.
Yeah. Well, we'll see. There's certainly a lot of complicated negotiations coming up on other matters, but in the critical mineral space, it does seem like Canada would be pretty central to all of it.
Absolutely. Absolutely, guys. It's something that Canada is really good at, and the U.S. and Canada should absolutely work together on stuff. I think, again, the supply chain is a complicated animal. There's the mining, there's the processing, there's the end stage for forging, shaping. There's no reason why that can't be done on a cross-border basis, depending on where the geology forces you to start.
Well, Oscar, our time is up. We appreciate it.
Thanks, everybody.
Please welcome to the stage Mike Greenlee, the CEO of MDA Space, Michael Pyle, the CEO and Director of Exchange Income Corporation, and Callan Rovinescu, the Executive Chairman of CAE, for a conversation with Bloomberg's Nora Melinda.
Well, good morning, everyone. Welcome. I'm Nora Melinda. I am a U.S. markets correspondent for Bloomberg Television. I'm thrilled to be moderating this discussion with such an esteemed group of panelists here, really just to talk about how Canada is investing in the future of its defense modernization here, especially as the country moves toward its armed forces to enhance capabilities. Canadian companies are really playing a major role here in this scenario. And so we're just going to break down what that looks like here for the companies represented here on this stage. Of course, to my far left, we have Callan Rovinescu, Executive Chairman of CAE, Michael Pyle, CEO and Director of Exchange Income Corp, and then right next to me here, Mike Greenlee, CEO of MDA Space. So I want to start with you, Callan, and we'll come down the row here, closer to me. Talk to us a little bit about what your company does, and then also how you're thinking about, from your perspective, what the most critical infrastructure investments Canada must prioritize in order to stay competitive and secure.
Thank you, Nora, and it's a pleasure to be here. So first of all, CAE is, at this stage, the world's leading simulation and training company, both for civil and defense aviation, aerospace, and in the military case as well, submarine training and mission readiness. So as we are now in Canada, I would characterize it as being at a generational change, a generational shift in mindset from a country that has woefully underspent on defense preparedness to some fairly ambitious targets. The Prime Minister has announced moving up to 2% within the next year, which Canada should argue have been at in the past, to 5% over the next decade. Those are extremely ambitious but important targets, which will mean that literally tens of billions of dollars need to be spent on improving this. And that involves everything from defense preparedness, space, which Mike will undoubtedly talk about, cyber training, capabilities with submarines. I mean, it's the whole shooting match. And so this is participating in this There's a little bit of history as well that one can look at. In 1959, Canadair was able to manufacture the CF-104 under license from Lockheed Martin. So therefore, we actually had manufacturing of some fighter aircraft in Canada. So you have an opportunity here to participate in the manufacturing process, in the training process, in the service delivery process, in the maintenance, repair, and overhaul process. This involves many, many, many different chapters of this. I might pause there, but there are some very specific initiatives that the government has already announced and worked with us before these announcements on defense preparedness.
Thank you. Mike Pye?
Exchange is a diversified company. We specialize in niche aviation. We fly to everywhere you probably don't want to go. But as it relates to what we're talking about today, we're one of the world's leaders in maritime surveillance. And what we mean by that is we manufacture the actual aircraft. So we're taking, whether it's a Dash 8 or a Bombardier jet, and we're putting anywhere from $30 to $200 million worth of sensing equipment on, and then we're flying them on behalf of governments around the world. It actually started here in Canada in the 1980s with the Mulroney government when they were trying to find ways to be more cost effective, and they outsourced the patrolling of Canada's 200-mile fishing limits on the east and west coasts. And over the last 40 years, that's grown to include every department in the government, including the military, looking for everything from Russian submarines to illegal immigration to drug running. And with the changes in the U.S. and President Trump demanding countries stand on their own, it's certainly been good, I think, not just in Canada, but around the world, for countries saying, okay, what do I got to do to look after myself? And that in and of itself has created a sense of uncertainty. Who do I trust? Who do I rely on? And all of a sudden, governments that used to get their information from someone else are now interested in doing it themselves. And so we're involved with the Canadian government to expand the contracts we have now from the east and west coast to surveil the north. If you can believe it, our biggest undefended border is across the North Pole with the Russians, and we've never surveilled that. That's going to change, but it's not just in Canada; it's a worldwide phenomenon. We've moved into 2 European countries in the last 4 years, and discussions are ongoing.
Thank you. Mike over here.
Sure. MDA Space is Canada's space company, Canada's largest space company. We're involved in 3 areas. Earth and space observation. So we build satellites and deliver services to observe the Earth and deliver that service to military customers and intelligence agencies around the world. Space surveillance, where we operate satellites to observe space and keep track of all the satellites and contribute that to the Department of National Defense, and that goes down to the U.S. Department of Defense. We work on robotics and rovers in space, so the Canadarm and robotics technology that we put on space stations and vehicles to service satellites and build and repair things in space, and then rovers for the moon. And then the third is communication satellites, so broadband data communications for communication data networks, and direct-to-device, 5G, in the future 6G, cellular networks from space directly to your cell phone. So these are the areas that we work in. Most of these technologies are dual use. So we provide these to the military in addition to the civilian or commercial markets. At this time, as mentioned, as Canada dramatically expands its defense spending, space is going to be relevant to that, as we care about the North, as was just mentioned, surveillance in the North, communications in the North, in addition to what I call like allied relevant contribution. As we move up to 5% of GDP, thinking about where Canada can play that's relevant to the allies and contribute something that, contribute areas that we're uniquely good at. Canada was the 3rd country into space that operate satellites after the United States and USSR. Canada was next. So we've been doing that for over 55 years. That's the age of our company. And so our ability to contribute meaningful space surveillance and space communication networks and space counter defense, which will be a spacecraft that you can use to protect other satellites and or go and take a poke at somebody else's satellite. As space gets more congested, it's definitely a military environment. And so that'll be another area where Canada can legitimately contribute in the future.
Mm-hmm. I mean, you all are coming from such distinct perspectives. We really have a diversified panel here when we're talking about all the contributions here to Canadian defense. I want to dig back into the challenges, which I feel as though each of you kind of flicked at a little bit earlier. I want to start here in the center with you, Mike, if you will. Talk to me a bit more about what you think some of the barriers are, in particular, slowing down Canadian defense modernization, and how, as industry leaders, you all can help the government to address these concerns.
Canada struggled with procurement for decades. The processes we go through are ungodly slow. They're so based in fairness and so based in wanting to make sure they make the right piece of equipment. By the time they choose the technology they want, figure out how they want to purchase it, put it out to the market and make a decision, a lot of times the market's already changed and we're bidding on the wrong things. And so I really believe there's a will in the new Canadian government to do things differently. And if they want to get to 2% in a year, 3% in 5, and 5% in 10, they simply can't. Even if they knew everything they were going to buy, they wouldn't get there. And so part of what the process needs to change is business has to take them solutions before the government asks for them. And so when I use the northern surveillance as an example, the government didn't come out and say, hey, we want to do this. But we said, look, you're doing it on the east and west coast. For the first time in Canadian history, I think all 3 Canadian political parties in the last election acknowledged we need to build a military presence in the north. Well, the easiest way to cover yourself till you get there is to surveil that vast land. And people, I think, don't understand how big Canada's north is. In our medevac business, we fly from Winnipeg up to some of the far north locations, and that distance to go pick up that person for an air ambulance is as far as flying from Winnipeg to the Panama Canal. And so if we don't have sensors, we don't have people looking, we don't have technology, we don't know what's going on up there. And I think the one other piece that I think is a little bit misunderstood is how the different technologies play together. Satellites play a massive role in watching what things do. Drones play a role, particularly in areas of conflict. Aircraft play a role where you need people to be able to make decisions. And so Canada needs a comprehensive group of these kinds of technologies to make it work. And so I think as a companies, we need to go to the government and say, hey, look, we can do this for you, and maybe not sell them a product, but sell them a service. We'll look after getting them stand up. We'll build the hangars. We'll get the aircraft. We'll sell you the information you want. And I think that will enable the government to move more quickly, more efficiently, and actually make decisions, because I believe there's a will to move quickly.
And I'm going to get back to you, Caitlin, for sure. I know you have some thoughts on this topic, but I want to know about the aerospace sector. How are you thinking about challenges? I know you touted a lot of things that Canada has been first for in space. How are you thinking about this right now?
Yeah, the biggest challenge is time, as mentioned. The biggest solutions are going to be, and the challenges within that are going to be people and processes. So we have to worry about people and then streamline our processes. Space is a unique opportunity because one of the biggest challenges on the personnel side is to have increased numbers of personnel to buy more systems, increased numbers of personnel to operate more systems, and increased numbers of personnel to maintain more systems. Space is an area whereby we can procure more quickly, and we can do it through commercial partnerships and commercial arrangements. The U.S. Department of Defense has a philosophy whereby they don't build what they can buy. If you can buy it as a service from industry that has an established capability, do it. Don't go and rebuild it just for the military. And so commercial partnerships are going to be really important. And then, of course, in space, you don't need people to operate or maintain it. You can put up a capability and really, really go. And so that's going to be extremely important as we go forward into the future.
Back to you, Caitlin, on that.
Thank you, Nora. So first of all, I wholeheartedly support what has been said thus far on the procurement challenges that Canada has had, and that there is optimism in terms of the early behavior of the Carney government. I'd call 2 things out. One that occurred last week, the creation of this Defense Investment Agency is a big step. It's a bit of a recognition that they actually changed the name from Defense Procurement to Defense Investment on purpose. The idea is that this needs to be seen as an investable industry. And for many investors in the room, this is a really good signal, in my opinion. They appointed someone who is a business person. He was vice chair, may still be vice chair at RBC, to take on that role, which I think is a great move. That is intended to, at least on the large projects, to facilitate speed, efficiency, being able to come to decisions. That's an important first step. Secondly, and it was touched on in both the comments that Mike and Mike respectively have made, partnership with industry. I think that we need to get out of the mindset of a supplier and a purchaser and a seller. And I think that has historically been where Canada has been. And I think that has to change. So if you have an understanding that the defense industry, the Canadian defense participants can be partners to government in that sense and take it out of the pure, supplier customer kind of a dynamic, I think a lot of progress will be made. Viewing it as being people who actually have a vested interest, of course, in their own companies, but who actually know something about this area. And that might help break the back of this procurement logjam. And then, finally, I'd say that when I look at the United States as a model who obviously has taken defense seriously for the last number of decades, they actually actively promote and support their defense industries internationally. And for the Canadian defense industry and Canadian defense companies to continue to progress, that has to also be part of it. So in the case of CAE, we operate in 40 countries, 145 different sites. That includes civil and defense, but 40 countries, a lot of countries. And if you want to build up when the United States wants to get serious about Lockheed Martin or Northrop Grumman or Boeing, they know how to do that. And I think Canada is an opportunity for all of the Canadian defense companies. But it involves this much greater level of collaboration, understanding that if we are serious about defense, we need to do a whole lot of things differently, including partnering with industry at a level that has not been seen before. And early indications, I think, are positive.
So, Mike Pyle, I want to dig a little bit deeper into surveillance. I mean, that's a lot of what you guys focus on here. How do you think about how opportunities Canada has to kind of position itself as a key player here in terms of NATO's efforts, in particular in terms of modernization?
One of the interesting things with NATO is, from the outside, I always thought it was kind of this monolithic group that everyone partnered and we shared information, and it's really not the truth. Europe, all of us are part of NATO. Canada's partnered with them. They don't share information, and so what's changing now is they're building platforms for how the surveillance equipment can talk to one another, what information they share, what they're searching for. Because one of the interesting things about surveillance, it's not just a pure military thing. If you look in Europe now, one of the great things that are going on with the tariffs and blockades against Russia is they're sneaking ships in and out. They're false flagging ships. They're running them through people's waters. The surveillance that's going now is actual countries talking to one another and saying, hey, this ship we think is such and such. If it crosses into your waters, be ready. And so when we talk about surveillance, it's massive different amounts of technology, everything from infrared to radar to ultrasound to cameras that can take a picture from 40 miles away with enough acuity to recognize your face. And so when they're tracking these things and trying to establish the rule of law in any number of different areas, communication between the governments and between the equipment itself is important. You talked a little bit about people. It's one of the great challenges the government has, is we've bought F-35 fighters. We don't have a place to put them or pilots to fly them yet. Well, if we're going to add surveillance, that's a whole level of pilots, it's maintenance people, it's engineers, it's facilities to put them in. And so in this environment, to move quickly, as you mentioned, we got to partner with industry who has the capabilities today that can ramp it faster, that can move more quickly and provide the government what it wants. And in surveillance, what the government wants is information. They don't want to fly airplanes. They want to know what's up there. And so it's taking advantage of what technology is there, and more important, or as importantly, getting them that information as quickly as possible. And that's where, like I say, I hope what we're seeing in the first part of the Carney government continues, which is a commitment to doing things differently.
Mike, how do you see Canada's defense industry evolving, and particularly in response to global geopolitical realignment toward things like space?
In phases, I think. I think that we talked a bunch about industry capability that's ready now. I think that as we ramp up our spend in defense, that we have to look at the industries that are ready now, partner with those industry, and be able to move out. But then there's opportunities for investment in what's next. MDA Space is the result of 3 strategic historical government decisions. One was to be able to have communication satellites to talk to all the reaches of Canada. The second was to put robotics on the space shuttle and the space station. And the third was to use synthetic aperture radar to survey all of our coastlines in the country. All 3 of those strategic decisions have resulted in us being world leaders in each of those 3 things. And so Canada's opportunity as we spend more money is to pick what's next in terms of identifying what areas of technology or military capability do we want to be good at next. So phase 1 is to leverage what's there and ramp up the capability quickly in partnership with industry while we're investing in what's next, and then ensuring that what we invest in actually becomes operational capability in what's next.
Mm-hmm. Well, sticking with you, since we're talking about the future here as we're wrapping here, if you were to look 10 years ahead, what does a modernized Canadian defense infrastructure look like to you?
Certainly a larger defense industrial base ecosystem, using the word that we used a whole lot, partnering with the Canadian military to be able to do those things. I think that in air, in maritime, and land, certainly in air and maritime and space the most, there will be opportunities for a larger expanded industry, leveraging what was mentioned about working with Canada to be able to export around the world. 10 years from now, if we're spending $150 billion a year on defense, which is what the numbers would come out to, you've got a much stronger industrial base partnering with Canada and exporting to other countries around the world as well.
Thank you. Kaylin.
You know, I think you have to start with the premise that the future of warfare will look completely different than the existing or the prior warfare. Meaning that, you know, if we want to be ready as a country, we need to, move much more quickly, because by the time something will be delivered, whether it's equipment, aircraft, submarines, you know, and training required for that, et cetera, that could be obsolete in the way wars will be fought. And that goes to, you know, being ready for unmanned vehicles. We saw in an environment, of course, in the Ukraine, where the use of highly sophisticated drones were able to do colossal damage to significant military equipment that otherwise not expected to have been the case. So unmanned vehicles, and then the training for unmanned vehicles. It's not as if you can show up with unmanned vehicles. So you have to understand what they are. You have to understand the technology that goes behind it. You have to understand what impact does artificial intelligence have with that technology. Does it, you know, cut down radar systems and therefore affect surveillance? Well, then you're going to have a response on surveillance. These sorts of things have to be anticipated, and you have to kind of invest in them now. And so I think, you know, I think each of the 3 companies here, and undoubtedly many other Canadian defense companies, would be wise to continue investing in defense tech as being part of what is necessary to continue equipping for the future generations of conflict, because they're not going to look anywhere near like the prior conflict. And we haven't actually talked too much about cyber, but of course, you know, that is a key component that you need to defend against. And so the interaction, and this is one of the things that CAE does, is the so-called mission readiness and the implications between land, sea, air, and cyber as defense mechanisms. And that integrated approach to mission readiness will be, I think, a big part of the future.
Thank you. Mike Pyle.
I don't have a lot to add to that. I think as we go forward, knowledge becomes bigger and bigger in the fights we fight. If you go backwards, it was brute strength. It was how many soldiers, it was how many planes, how many things you have. And now it's really about discrete, small things you can do. It's amazing what in the Ukraine-Russia war, what we've seen, small, relatively inexpensive drones, the damage they can create because the systems weren't designed to prevent against them. And I think you're going to see more changes like that as our world is more and more based on digital and electronic knowledge. I think people are going to be attacking the sources, the abilities, and those things. And so we're going to need to be ahead of those processes, and we're going to be able to watch to see what our enemies are doing. And I don't think we can lose in what's going on in the world, that there are allies and there are people who are our foes. And we need to team up with our allies, but make sure we're talking the same language and make sure we protect one another.
Well, thank you all so much. With that, we'll leave it there. Once again, thank you all, Mike, Kaylin, for such a wonderful, insightful discussion. And thank you all so much for joining us here today.
Thank you.
Please welcome to the stage Harry Taylor, Chief Financial Officer of Hydro One, for a conversation with Bloomberg's Noreen Malik.
Hey, Harry, thank you for joining us.
You're welcome. It's a delight to be here.
This will be rapid fire because we stand between lunch. So.
Okay, here we go.
So give us a very quick update on Hydro One, transmission and distribution company, but talk about your customer base and where you're at.
Sure. So we're a fairly simple company to understand. We are in one jurisdiction, the province of Ontario, largest province in Canada in terms of population, 40% of the population, 40% of the GDP. Diversified economy. We've got everything from heavy industry between steel manufacturing, automobile parts manufacturing and assembly, right through technology, financial services, and agriculture. So a full spectrum, diversified economy. Had a lot of growth, economic growth and population growth over the last number of years. Those are expected to continue. And as a result, we as an electric utility, as you mentioned, are in two businesses essentially, distribution and transmission. We are the transmitter of Ontario. We own all of or a stake in every transmission line in the province except for one. And we're the largest distribution company, local distribution company in terms of wood poles and wires to homes and small commercial and industrial businesses. As I was saying, we have about 1.5 million wood poles. We also have about 1.5 million customers. Our customer base on the distribution side is primarily rural. We're not in the major urban centers. Ontario is the home of hydroelectricity, hence the name Hydro One. 25% of our power is from hydroelectric sources, primarily rivers and dams. 50% is nuclear. 16% is natural gas, and the rest is renewable. There's no oil, there's no coal. And the goal of the province is to get to full green energy, of which nuclear is a part, by 2050.
And Ontario is seeing pretty strong power demand growth. Can you talk about that?
Yes, it's interesting. I haven't been with Hydro One that long, so I had a vision of, or an image of utilities, electric utilities being slow to no growth, very bureaucratic, et cetera. It's anything but. That may have been true, but we are seeing unprecedented levels of growth that we've already realized. And as we look ahead, the system planner for Ontario estimates that electricity consumption will increase 75% between this year and 2050. So on a straight line basis, that's about a 3% CAGR for 25 years. Now, by tech standards, that's not that great, but by utility standards, that's rapid. And what we need to do is invest to enable that, and at the same time, ensure we're investing to improve the resiliency of our grid.
Now, to be able to do any of that, you need money, and you're on a mission here. Tell us about your.
I'm on a mission. So, as you say, we've been lucky as a public company. We went public in 2015. We've been able to fund all of our expenditures and operations from funds from operations and borrowings. We're an A-rated utility, very proud of that. But as we look ahead, the accelerating pace of investment is going to require more debt, but also some equity. On the debt side, we've been exclusively Canadian. We've always issued bonds in Canada. We, in August, filed a shelf prospectus to issue here in the United States, and we intend to have an inaugural issue within the first 6 months of next year, and that becomes an annual occurrence, just to diversify our investor base.
What could that inaugural issuance look like in terms of total amount and any terms, tenors?
Well, that's a great question. So we haven't landed on it, and we're talking with investors now to get a sense, since we're not known here. In Canada, we do everything from 5s, 7s, 10s, and 30s. Here, for an inaugural issue for a new issuer, it feels like a 10-year tenor is probably the right one. We want it to be sizable enough to be interesting to investors, so anywhere from $500 million to $1 billion to make it meaningful for folks. We don't want to overshoot. At the same time, we don't want to undershoot and leave too many people wanting too much more. So there'll be a lot more to come as we get ready for this and start conducting some of the marketing in the new year.
So a lot has changed in the last couple of weeks. The U.S. government is shut down. How does that affect your perspective, like just that and looking at the U.S. overall?
There's a lot of headlines that come across the border, et cetera, et cetera. I think we're taking the medium and long-term view. There's lots of issues in both countries, but we're investing for the medium and long term. Our outlook is there, and we think the government will find a way to start up again. The parties will come together, come up with something. It doesn't really interfere with our business in any way. We're happy to export. We do export a fair bit of electricity. In terms of funding, we don't see any anomalies developing in the market. We have to be commercial, so if something changes in such a way that it's uneconomic or disadvantageous for us to issue here, then we'll hold and wait till the conditions change. We don't have a natural use for US dollars since we're in one geography, so we have to swap it back, and we just have to make sure that the swapped rate, all-in rate, is competitive for us, because we have to look after our customers, our ratepayers, to ensure we're not doing anything that's imprudent or driving costs up, which will drive rates up.
In Canada, I believe Hydro One is the largest issuer of green bonds. Is that something you're looking for in the U.S., or is it just like regular, like green is not?
There's no premium, if you will, or greenium, if you will, for that. So we're certainly proud of our sustainability record and our environmental focus. But it doesn't have to be labeled a green bond, and we don't think that'll yield anything more for us. If investors are interested in that, we're happy to try to meet them, because we have a terrific sustainable financing framework, award-winning sustainable financing framework. But our initial issue, probably not issued under that.
And you mentioned a lot of demand growth. Will this be used to fund that, or what's the plan?
Yes, so we have organic growth, population growth, economic growth that just continues along in the distribution business, but our transmission business is the real needy business from a incremental capital point of view. We have 9 more transmission lines to build between now and 2032, and we expect to win or be designated as the designer and constructor of more lines to support the nuclear build-out that is happening, and I think was discussed earlier this morning. We have to enable all that electricity gets transmitted and distributed to the homes and businesses in Ontario.
Now, that sounds like a lot of transmission building in a short time. In the U.S., it can take 10, 17, 20 years to build a long-haul line. How are you finding success?
We are, thankfully, we don't have those durations. So we're confident that these 9 lines that we've already been approved and designated are in various states. They'll all be done by 2032, 2033 at the end. Part of the reason we've been able to do things fairly quickly by transmission standards is our First Nations partnership. So in Canada, we have a focus as a country for economic and social reconciliation with the First Nations in our lands. All of our transmission lines will cross some, if not exclusively, First Nations lands. So we have a 50-50 partnership model where we work with the nations and give them the right to purchase up to 50 or 49.99% of a transmission line that runs across their lands, and also to procure services and goods from Indigenous-owned businesses, either in the construction or the maintenance of the lands. And what we found is by partnering with them, and we don't wait till the line is being prepared. We start months early, or years early. We know where the next lines will be. building relationships, establishing relationships in the community, investing in the communities so that they become our partners. And often at least in Canada, transmission lines, regulatory and approval process take a while because for First Nations are opponents. Either the land rights haven't been negotiated, there's sacred burial grounds that need to be rooted. When you're a partner with them, you work with them, they become your proponent as opposed to opponent, and they make things happen. And so we've been able to accelerate approval processes, actual construction processes, and energization so that they can participate in the upside.
What kind of timelines are you talking about when you say accelerate? Is this something done within like X number of years and it took 5 or 10 years?
Yes, so you were saying 10 to 15 years, so we're at anywhere from 2 to 3 years to 4, depending on the length of the line, the complexity of it. But the work starts before the construction starts. So from absolute beginning to end is anywhere from 5 to, say, 8 years at the outside.
Are there any lessons learned in interacting with First Nations or how early you get them involved?
You're never early enough, number one, to understand every nation has some uniqueness to it, and so understanding what's important for them and their nation in terms of economic reconciliation and what is literally and truly sacred versus not, but enabling them to invest and participate and be part of the process is an absolute winner. And we know this based on our record of working with them and hearing from them. But in addition, the lines that we've been awarded, either in a competitive process or in a designation, often we see the partnership that has been established is one of the deciding factors.
So they take a 50% equity ownership, right? Can you talk a little bit about when they come in and how that works?
Yeah, so it's, for us, we take a lot of risk up front. So we take all the construction risk and we work with our EPC contractors, engineers, et cetera, do all the design, the development, and the First Nations partners, but we don't look for them to invest until the line is constructed. The rate application has gone in and been approved. And from the moment the electricity is flowing up until a year after that, they have the right but not the obligation to buy from us equity in the line. It doesn't cover the stations at either end. It's the cables, the wires, the poles, transformers, insulators, conductors, et cetera, all that. We keep, just because there's other assets coming into those stations, it gets very complicated that way.
And then are you helping them with the financings on that end, or do you have a role?
We do have a role. So Kevin Dickinson, our assistant treasurer, is here. He and his team are integral to ensuring they have availability of financing. We don't guarantee it, but we'll do everything we can to make introductions, ensure there's multiple sources of funds. Some nations have the cash on their own, a lot don't. This is a great investment for them because right now there are, and for the foreseeable future, there's both provincial and federal loan guarantee programs. So the nations effectively borrow at the rate of the Government of Ontario, the Government of Canada. So that's in the 4s. They're earning 9.2%. On these. So it's a great return, but we don't guarantee it. We don't want to take that liability on our books.
Now I have to ask about data centers because I'm in the US, so that's all I write about. What are you seeing? Are they knocking on your door, or is that mainly they're going to the generators and you're just hooking up the generators?
Well, they're knocking on the door. It isn't as dramatic as some of the headlines here, here being in the United States around what data centers are doing, et cetera. We have about 10 gigawatts of applications in process, but those same applicants are also talking in Alberta, they're talking in Virginia, they're looking to source different things. So for us, we see it as an opportunity. It isn't that dramatic. They tend to co-locate or locate very close to generation, so it's a bigger opportunity for the generators to get some base load and amortize some costs. We're happy to support in any way. Our one caveat is we want to make sure that geography is considered. Southwestern Ontario, from Toronto through to Windsor, Detroit area, highly congested, needs more power brought in. The last thing we need is another data center in Southwestern Ontario, because that'll just create more problems in the grid.
Do data centers have to register with you to come online? Like, how does that work? There's different processes in the U.S.
Yes, they don't have to register, but we're involved. So when they make a proposal and it put in a formal application, we are one of the parties to the work to ensure the solution is designed as effectively as possible before it's approved.
Now, all this new demand growth is coming at a time when we're seeing grids across North America facing greater stress from extreme weather. How are you bolstering reliability, whether it's extreme winter storms or are you seeing wildfire risks?
Thankfully, we're not seeing wildfire risks. So the province of Ontario is rated either low, very low, or negligible in terms of wildfire risk. Having said that, there's not none. It just, they're not anywhere close to any significant assets or, thankfully in most cases, population centers. This year, we're actually over where we were last year, but below the 10-year average in fires, and we've had no real loss. For us, the natural disaster that we worry more about is wind and ice. And we did have what we call a generational ice storm roll through March 28th of this year that took a huge swath of our assets out of service and our customers out of power for as long as 3.5 weeks. I mean, it was catastrophic. That's something that we have normal storm restoration. That was extraordinary, and so we file a Z-factor application for extraordinary relief. That has been filed, and we can hopefully get that approved. That'll be put in our rate base, and we don't have to defer others. So to answer your question, it's wind and ice more than wildfires. We monitor it. We do lots of things to ensure from a forestry and vegetation management, we keep our assets as low risk as possible, but they're always going to be there because we can't do everything to absolutely prevent it. And undergrounding is not going to work. Too much Canadian shield that you're just not going to put everything underground.
On that note, thank you so much, Harry. Really appreciate your time,
welcome.
and it's time for lunch.
All right, thank you.
Thank you.
All right. Thank you so much, Noreen and Harry. I think you did a really good job of keeping that moving. And it was a great morning for the 13th annual Canadian Finance Conference. It is now lunch. Yay. So lunch will be served across the courtyard at Hutong Restaurant. For those of you who were here last year, it's the same restaurant. So you would go downstairs and then take the elevator to the ground floor. Once you badge out, exit to your left and cross the courtyard. You can't miss it. Please do keep your badges with you as you will need them to get back into the building. And we will see you all back here promptly at 1:40 p.m. Thank you.